back to the second day of Persistent Barriers, New Frontiers. I'd like to introduce our first two speakers, and apologize for running late. We have Jonathan Donner, a Director of Research at Caribou Digital, and we also have Chernay Johnson, Director of Research at DFS Lab. Thank you.
To have decided to go from the dining room to their rooms.
Forward, and the small button is backwards.
Fantastic. Thanks. Yeah, so we're going to share our presentation today, which is good. Chernay and I are in similar roles in sort of sister organizations. The Caribou Digital is a small research consultancy. We focus on building more inclusive digital societies, and most of our clients are foundations and bilaterals, multilaterals, digital development sort of work. And the DFS Lab, where Chernay is the Director of Research, is an early stage investor, mostly but not specifically in Africa and sub-Saharan African markets. So we're going to talk a little bit today about financial inclusion right now, right at this moment, and try to kind of extend the picture a little bit into including some of the proximate tech players and actors that are around and a part of financial inclusion in a way that maybe we weren't expecting and we still need to all make sense of. In particular, we're going to talk about the platform era and the rise of marketplace and social media platforms as a real force in people's everyday internet lives. Can I see this from here? If I come way up here, I can see my little bit. So the three main things we'll cover would be to get from these platforms to financial inclusion and back, we're going to talk about livelihoods, digital livelihoods, basically how many people are earning a living. Then we're going to talk about how hard it is to figure out just how many of those people there are. And then we're going to actually get into, Chernay will do a mapping of who is doing this and how. I will then come back at the very end to raise a couple questions that specifically link to some of the discussions yesterday and some of these big tensions about what this all means and how we move forward from there. So this is a quote from the leaders of CGAP right before the leadership changed, but talking about their future strategy. And I won't read the whole quote, but basically CGAP was an organization that spent a lot of time thinking about getting people bank accounts and getting people access to credit. And they've been wrestling lately with how they've been thinking not only about those things, but also, as she says, this is Greta Bull, eventually it became clear that not only do we have financial services have changed dramatically in the last 30 years, but so have the ways people earn a living. Globalization, demographic trends, climate change, technology, all of these factors are changing people's livelihoods. And if there's one thing that is central to people's needs, it is the ability to earn a stable income. So CGAP, and I use them here as a representative of not, they're not the authority, but they are a group that's been thinking about financial inclusion for a while, has got this kind of livelihoods on the mind, and particularly digital livelihoods on the mind. So I think one way to represent this, and these are things we talked about yesterday, is that the kind of underlying ideas and frames that animate financial inclusion for the poor have gone through several stages or picked up several things along the journey, right? It's not like we ever give up on anything. But 30 years ago, people were writing and talking about and doing work in small enterprise development and thinking about sustainable livelihoods of the poor and that framework from DFID, market systems for the poor. A bunch of stuff about helping people earn a living. Microfinance movement really took off, moving into kind of group lending situations, working capital loans to micro-entrepreneurs, and there's a whole conversation about that, bigger than what we can have today. Then mobile money and DFS came along. The big pivot from microfinance to mobile money being you switch out of a group model into an individual model and you deliver through the phone. Ton of innovation we've been talking about there. So far, no news on this slide, right? But the one bit of news would be what I want to add there at the end, which is digital livelihoods. That's that quote from CGAP on the previous slide. There are emerging conversations now about reapproaching how it is that we understand people are making money, earning a living in a digital age when they're connected through their smartphones. Effective use of the financial services they have. What do they use the credit for? What do they use the savings for? What do they use the insurance for? And the really important role of platforms in these things, that platforms are the way most people touch the internet now. Sorry, wrong slide. So, what do we mean by platforms? We use it from time to time. It's a dangerous word because everybody uses it all the time and then uses it in a bunch of different ways. Okay, so I just want to put one definition down. Platforms are the mechanisms for hosting interactions and exchange between third parties, where the host, the platform, facilitates value creation, financial or otherwise. It takes a share of that value, but it doesn't completely control the scope or the interactions that happen between players. So Uber's a platform, eBay is a platform, Android as an operating system is a platform, Facebook's a platform, Facebook's actually many platforms, Google's many platforms. There are a lot of different platforms. To some extent, it's as old as it's as old as human civilization. The marketplace was a platform. It just was scaled and bounded. It was only in the center of the town. Now those marketplaces are infinitely sized, super flexible, find you where you are, satisfy all these needs that you've got in a ton of different industries. So even in Africa, even in any African country, you'll find local and international platforms, dozens, if not hundreds of them active in every sector. So there are gig work platforms, and there are marketplace platforms for goods and services. There are information platforms for helping civil society run better. There are global online work platforms for freelancing, whether it's a tiny job of just like figuring out whether you're looking at a tree or a fire hydrant, or a massive job in like rewriting somebody's whole website. You can do that all remotely through something like Upwork. And then there are the attention and social media platforms that really are the front door to the internet for almost anybody with a smartphone. Platforms play an incredibly important role, and they've got a role to play in financial inclusion. The development community knows this and is starting to wrestle with the platformatization of the economies and the good and the bad that can come from that. These are by no means booster documents. The ILO is worried about the quality of work in gig work. UNCTAD is very worried about the quality of trade and the terms of inclusion for small enterprises and for countries in the global south. And then the UN's Digital Cooperation Commission is just worried about the whole system we're building and whether the digital interdependence that we're building is a good system or not. Open live debate right now about what kind of future we're building with these platforms. Policy approaches, look, there's a ton of people talking about things you can do to make platforms work better for more people, maximize the good, minimize the harm, whether that is regulation, protection for workers, whether it's improving job conditions for gig workers, reducing automation, a lot of stuff that can happen. There's a smaller version of that conversation which should be happening in financial services and in financial inclusion, which is what we'll mostly talk about today. Here's my one theory slide, and I'm just going to point back to it, which is what's old is new again. This sustainable livelihoods framework with all the boxes and arrows is a DFID generated kind of framework for thinking about how the poor make money, how people earn, that isn't specific to jobs. It's very combinatory. It talks about assets and connections and processes and structures and livelihood strategies that all aggregate up to the fact that the reality for a lot of people is they make a little bit of money in a lot of different places in strategies that work well for them. That was 30 years ago in analog and made a lot of sense to put development policy around. And it actually makes sense now. If you look at a platform life, one of the things that platforms let people do, whether they are poor, middle class, or doing quite well, is do a little in a lot of different places and cobble together a kind of a livelihood that makes sense. So I'm not talking about jobs. I'm talking about livelihoods. This is the overall framework that Caribou Digital has been using to make these connections. We talk about platform livelihoods, and there's a bunch of different papers at platformlivelihoods.com if you want to look at it. They've got papers on a bunch of different sectors in Kenya, platform sales and gender in Kenya and Nigeria and Ghana. We've just launched one on agriculture and platforms. But basically, I would argue that we spend a lot of time thinking about this working bucket, right? We think about gig work. Yeah, people have platform-mediated jobs when they're doing gig work. But there are as many, if not more, people who are platform trading. They're selling on these marketplace platforms, or they're selling on WhatsApp or Instagram or Facebook, and doing something quite natural, but kind of making Facebook an extension of their little storefront. A lot of that happening. There's less of that renting and asset sharing happening, but it's like the sharing economy and Uber and all that. So we wanted that in the mix. And then creating is just using clicks and attention to earn a living. And although there aren't many of those folks among the communities that we research, it is a way of earning a platform livelihood. So when I put it this way, that platforms are common, and that there are many ways to earn an income using platforms, you start to realize that, wow, there actually may be lots of people who are already earning or depend on a platform or platforms to some extent in their life. So how many? I wish I could tell you. And this is where we are right now. Shernay and I are working on a paper and a project in Indonesia, where we've actually, did we promise we would figure out how many there are? I'm not sure, but whether it was a good day or not. But we're trying because the numbers are tricky. Here was the Africa case, where this is from Insight to Impact, and it's a couple years old. Shernay, you were part of this project. That figured out, made an estimate that there were 4.8 million platform workers in Africa, and this was already several years ago, working across 270 plus unique platforms. But let's figure out why those numbers are so hard. There's only really 3 things you need to take away about this. It's difficult to count platform workers and platform sellers for 3 reasons. Because of livelihood strategies, one person is likely to use more than one platform to earn a living. If you're a shopkeeper, you're on Instagram and you're on TikTok. Okay. You may earn your living only partly through a platform. If you're a taxi driver, you may do some rides on, through the app and take some rides off the app. And you may actually have a shop or a car or something where you employ somebody else to help you kind of pursue your platform life. Right? So getting a sense of that footprint is really, really tricky, but I do think it's important for policymakers to know how big of a part of the puzzle this thing all is. So in Indonesia, our estimates now are it's somewhere between 5 and 29 million out of about 130 working age Indonesians, or Indonesians in the workforce, 130 million. How many depend at least partially on a platform? Somewhere between 5 and 30 million. E-commerce, the big blue bucket, is the biggest one by far. People whose little stores are attached to platforms is the next biggest bucket. Social commerce, just using WhatsApp, also big. And then gig work in yellow is actually relatively small compared to everything else, which I think is important. People always want to think about gig work as the future of platform work, but sales is arguably more important. Represented another way, I think the shading doesn't work here, so I'm going to skip this one for now. I'll just tell you this. Just because we found 30 million people who earn some money from a platform, that doesn't mean that we have 30 million people who exclusively earn from a platform. It's probably only about 1 in 6 is a full-timer. Everybody else is part-time, which is important for the financial services conversation that we're going to go to next, because as livelihoods have switched and sort of fragmented into a bunch of pieces, well, you've got a bunch of different touch points where if you wanted to put a savings plan next to a worker or an insurance plan next to a driver, or a credit plan next to a small seller, there are actually multiple touch points you could do that for, which is why it's so great that, in a way, financial services is being disaggregated into several pieces right now. So with that, I think Charnay is going to tell us a little bit more about what that landscape, the disaggregated landscape, looks like in Africa at this time. Thanks.
Jonathan. Okay, Jonathan's taken 20 minutes, which means I have 10. I'm not going to waste any more time, but hopefully they'll give me just a few minutes to kind of get into this. So the bit I'm going to talk about is really the intersection of livelihoods and the tech stack that is being built in Africa. And I'm here, from the view of an early stage investor, but also someone who I think bases a lot of our investment thesis around real research and asking some hard questions about what could be scalable in Africa. And there's a bit that we always talk about, which is the frontier blind spot, right? So, digital economies, digitalization, lots of positive sentiment has been there around it, especially in a post-pandemic world. Everything's accelerating. 4 new unicorns were minted last year, specifically fintechs like Flutterwave, OPay, and others. But the reality is that African markets look very different from the rest of the world and from Asia, right? You can hear startups talking about 200 million people in Nigeria as an addressable market. But really in Africa, you've got a large proportion of consumers and workers that have very low incomes, and their purchasing power is really constrained. Not only that, they're all not smartphone enabled. We've got basic feature phones, typically sort of analog technologies that are being utilized. And so we looked into some data from the World Bank, which really looks at sort of consumption and income distribution curves. And we're finding that a lot of the startups or the bigger ones that are kind of scaling mid-stage and later stage, they're actually only capturing about 5% of the population, which is earning or consuming more than $10 a day. And those are your digital-enabled users, your smartphone users, most of the people in this room, right? And I think impact donors, development actors, governments, they've been thinking about how do we induce these for-profit models to serve the bottom of the pyramid. And so we looked into this, did some modeling around the cost of customer acquisition, and we think there's a sort of middle of the pyramid that spends $4 to $8 per day that could be reached by some of these for-profit models. The bottom of the pyramid is almost unreachable, and that's where the majority are. That's 50% of the population. And maybe some of the tech providers like Pasesha and Inclusivity Solutions will tell us a little bit more about the challenges of reaching the very poor. But I want to talk more about the sort of middle band. We think there are some ways to reach them if you can get the cost of acquisition really low. We think that could break the logic. We think that if you're operating in a space of, either providing or reducing or, kind of bringing together more optimal supply chains around FMCG and food, you're probably going to reach this middle of the pyramid, because we know for Africa, 40 to 60% of the consumption basket is really based around food, right? There are also, Jonathan spoke about some platforms that are, kind of at the point of supporting people and micro enterprises in improving their livelihoods. He spoke a lot about micro sellers, hyperlocal sales that are being enabled or in some way tech enabled. And we've been looking a lot at B2B platforms that are really serving the informal retailer in Africa. So here we're talking about your spaza shop in Cape Town, or your duka out in Nairobi, your kiosk in Lagos. We can call them what we want, but it's basically your corner shop, your mom and pop shop. They're trading very small quantities per day, but essentially here we've got 5 or more columns of products and solutions that are being developed by tech players to try and support them, all the way from sourcing their products, getting their products delivered to them at better prices. That's helping them with some cost efficiencies. They don't have to go to the market for half a day and spend all this money on transport costs. I mean, we surveyed more than 2,000 micro retailers, and they said that's one of the biggest issues, and also the reason why they use many of these applications. But for early stage to sort of growth stage companies, it's not very profitable in the beginning. Most of these products and solutions are being offered on a freemium basis. Even in the FMCG sector, we think margins are around 3 to 5%. You know, getting the goods out costs you 2%, so you're not making much. But there are 3 areas we think that there's a role for financial inclusion or some link to financial inclusion. And that's in the payment space, more on embedded finance. So can you bring in, you know, invoice factoring or other BNPL credit methods for SMEs? Possession is trying to solve some of those challenges out in East Africa and elsewhere. And they're very importantly, you know, there's the bit about agent seller networks, which we know have worked very well in the mobile money industry, and there's something to learn there. And I think the sort of last bit I want to touch on is just this concept or notion of tech and touch, or what we're calling building cyborgs, not androids. So, you know, companies can come in and they can decide to completely digitize informal arrangements, completely shift them, shape them. But I think as we were discussing at dinner last night, a lot of the informality, they're sometimes called irregularities, they work in Africa. So why not bring tech in a way that is going to support those functions? And I think optimize them in a way that, you know, brings benefits to that micro retailer or that low-income consumer. And we've seen a lot of players, you know, attempting to do this. You know, the ones we most often talk about is, you know, your Twigger Foods, your Copier, which is bringing goods to peri-urban and rural areas in Kenya through group buying models. But there are also others that we're invested in, like Bumper. So Jonathan was talking about social media applications. They're making it possible for, you know, micro sellers online to bring together their clients on WhatsApp and other meta platforms, bring that all together in a sales function, you know, issue invoices and keep track of their records, which is so important because, you know, when you're on the side of manual record keeping, there's not really a transaction history that can put you in a position to have a sort of basis for accessing credit. In neobanking, we see a lot of struggles. You know, everyone thinks that the digital bank is the golden goose. It's not always so. Kuda and others are really struggling with profitability, high rates of non-performing loans. And there are some, however, like Team Apt and others that are really, again, using the kind of cyborg build around this, really leveraging agents who are on the ground and are interacting with consumers at every point. There's a physical touch point to be able to do that. And they're also recognizing that cash is still playing a dominant force in these economies. So they're not trying to, you know, disintermediate the concept of cash in, cash out. They're actually working with that structure in mind. And so I think what I want to end off is that, you know, we're seeing a few very interesting areas from our investment perspective, but it's important to note that a lot of these models are being battle tested. They do break down. Some of them will not reach the absolute bottom of the pyramid. And so I think it's important to know that there will be failed experiments along the way. And hopefully there's a space for, you know, for-profit models to really figure out on how they're going to be able to reach, I think, this middle of the pyramid or further down. And I think Thursday's conversation about cash transfers and other means of reaching the very poor is probably going to shed some more light on that. So that's where I'll end, and I'll hand over to Jonathan just to frame some animating questions.
Thanks, Shanae. Just So just, and this, wow, what a terribly ugly slide. I'm sorry, this is last minute. But this one is trying to connect to some of the questions and things we were talking about yesterday, and to build on the portrait of the dynamic space of innovation that Shernay was able to lay out. The first is that, how we currently see digital financial services, M-Pesa, even fintechs, are not the end of the story or the whole story when it comes to financial inclusion. The futures of financial inclusion and of platform marketplaces are intertwined, right? So as these platform marketplaces try to grow, they try to offer financial services to the small businesses and individuals on their network. So they're intertwined technically because of unbundling and because of embedded finance. They're intertwined behaviorally because the money making and the money saving and the money moving are kind of all happening digitally connected to each other. And I think this is a point that will resonate with some people from yesterday. They're connected at the ideological and the structural levels because it's that sort of same platform and tech-led and investment-led models that are building the next generation of financial infrastructure are also building the next generation of digital market infrastructure. So these are connected. So even if all you are interested in is the financial services and financial inclusion part of this, I would implore you to look at what's happening in the marketplaces to understand what financial inclusion looks like and means for the time moving forward. The number of folks who this is actually already touching is a little bit indeterminate. It's probably at least 1 in 10, maybe it's 1 in 5 in many of the markets we're working in. There's a ton of innovation happening right now, as Shernay said. And yet, and this is my last point, but persistent barriers do remain, to pick up on our topic of our discussion here. It is still the case that most of these platform models struggle to do much to help the most vulnerable, the most marginal. These are things that work better for the emerging middle of the pyramid than for the bottom of the pyramid. The use cases are focused on the middle class. KYC, know your customer, and ID more broadly are real barriers to using these sorts of new financial services and to use the marketplace platforms themselves. And the kind of life with the algorithm, whether you're in sales or particularly if you're in work, it can be a nasty place to be. That the way earnings happen on these platforms is far from sunny, right? And we need to understand all of those trade-offs and keep tracking that and build the evidence base for the regulatory interventions that need to happen to protect workers and small sellers as this sort of the digitization of these markets advances. Thanks very much.
Jonathan and Shernay, and thank you very much for keeping time the way you did. And there's plenty more to talk about, and we will have a very rich discussion, I'm sure. Our next speaker is John Sharp, Professor John Sharp, Director of the Human Economy Research Program, and as well as myself, Sibel Kusimba. I have a small ghost work. Speaking of Mary Gray and Siddharth Suri's book, Ghost Work, I have some ghost work on this paper. But anyway, go ahead.
That's one way of describing it. She actually said to me, "You present it." And I'm sorry for speaking twice in 2 days. It won't happen again. This is it. Okay. So the we is Sibel and me. In this paper, we seek to make several points about fintech interventions in Africa aimed at financial inclusion. Much more simple, much more basic than our colleagues here have just discussed. The first point is that fintech innovators and entrepreneurs who demonstrate respect for what the mass of low-income people across the continent are able to do for themselves are more likely to have a positive impact than those who disrespect these people by believing and acting on the idea that everything these people are able to do needs a complete upgrade. It's all broken. Get moving. The second point is that it is not impossible to push for certain limited upgrades respectfully. But innovators and entrepreneurs embarking on this path need to find plausible ways around people's justifiable hesitation about embarking on courses of action based on premises unfamiliar to them. The third point is that there are certain areas of innovation which will always lack we think, will always lack significant benefit for poor people, no matter what efforts innovators may make to be respectful. We derive these points from our conversation with the representatives the representatives of 4 fintech companies during the first Human Economy Conference on Digital Finance in Africa's Future in 2018. And from our subsequent reading of as much literature about these particular companies and other similar ones as we could find. I'll mention the companies in a moment. There is no possibility of hiding them and calling them Company A, Company B. And I've already mentioned to Jeremy, sitting there, that his company is one of them. These companies are not representative of any larger population. Of course they're not. And the points we make can be nothing more than suggestions for discussion. We will discuss the 4 companies in turn, their visions, interventions, and the outcomes of these interventions, and then attempt to draw out some wider implications. So the first company, which I've under the heading Respect, the first company is MFS Africa, which I suppose many of you have heard of, is a company that showed respect for what people on the ground in Africa did for themselves. How? Its founder and CEO, who was at the conference in 2018, and we invited him to come here, but for reasons I'll explain later, I don't think he's got time to come. Its founder and CEO, Dare Akuju, paid careful attention to the way in which people on the ground virtually, his words, the poor people in Africa, virtually invented mobile money for themselves, as he put it, by using airtime as a means to transfer value person to person. When people were doing this, he was head of mobile money development at MTN, which of course was the main rival at the time to Safaricom. He understood, I think probably more clearer, at least than anybody at M-Pesa or Safaricom managed to communicate in all the stuff they wrote about inventing. They got a British, as you know, M-Pesa Safaricom got a British tech company to do much of this at a distance. But of course, Dare Akuju was on the ground. He understood why people were sending airtime from one mobile phone to another. It added another way of transferring value to the repertoire they already had at their disposal. You could send money by bus. You could put it in your back pocket and go home. You could entrust it to somebody else. You could send a postal order. And this was an additional one. At no time could you ever say, I'm going to replace all of this other stuff. Keep going, he said. But there will be certain circumstances. There will be certain, excuse me. There will be certain circumstances, thanks, under which this new form that you have pioneered, sending, because you can, of course you could right from the start, you could send airtime from one phone to another phone. It added another way of to the repertoire. And it was useful. It had certain advantages, particularly if cash-out agents were readily available to give them a meaningful choice. The problem with airtime was that you couldn't cash out. You had to, not formally, you couldn't get the airtime agents across Africa to actually cash that out for you. They were not allowed to do it. I would suggest the most significant aspect of mobile money invented, and whether it's MTN, we're talking about their mobile money, or Safaricom's, was that they allowed they turned the airtime agents into mobile money agents and trained them up to cash the money out. which made it so much more convenient, because with airtime you had to go and find somebody else who wanted airtime, and they bought it from you, and so on and so on. It could be a palaver. Otherwise, it fitted into the notion that one of the main purposes of money for low-income people was, alongside other valuables that could be transferred, to construct and maintain networks of relationships of sociability and mutual assistance. They seized on that. They were already doing it, and he saw that. Right. And I think he's clearer in what he said at our conference and what he wrote in other contexts. He's clearer than than Safaricom itself, who tell you the story of how they made a mistake and they first developed it as a way of paying for credit, an easy way of paying for credit. He didn't make that mistake. This is about transferring money from one person to another. According to Okuju, mobile money was little more than a minor adjustment to airtime transfer, and the organizational change that airtime agents were recast as agents who could cash mobile money out was more significant than any technological innovation involved. He said very clearly, several occasions, mobile money is really about the agent network. It is not about the technology, in his view. Very powerful argument. As soon as MTN launched its mobile network-operated mobile money in 2009, remember, MTN already had bank-issued mobile money in South Africa with some of the banks here. So it was that additive form of mobile money. You had to have a bank account, and then they gave you some mobile money. But of course, the introduction, both MTN, but first M-Pesa, this was mobile money issued on telephones. As soon as his MTN launched its MNO-issued mobile money in 2009, Okuju left and founded his own company, MFS Africa, possibly believing that MTN, I think he got impatient, was reading between the lines of talking to him, I think he got impatient. He thought that MTN would simply concentrate on enticing its mobile phone customers to adopt its mobile money, rather than on fixing the technical problems, rather than on fixing the technical problems which prevented customers from deriving maximum benefit in the areas they had already shown were important to them. He developed, of course, an API. He wasn't the only one. Of course, Safaricom worked on it at exactly the same time, but I think he moved fast. He left MTN, founded his own company, and said, interoperability is the big issue. There's no point if all you can send money to is your relative on the same network as you are. You've got to be able to send it across networks, and I'll design the API, which he did, which will enable that. The second thing he worked on, which he said was much more complicated, he said it actually almost got him to the point of throwing in the towel, was to make money transferable across borders. Now, again, he's not the only one doing this, but he was at the forefront of it. So he had to negotiate with governments for regulation changes that made cross-border transfers possible to cater for, and this is something he highlighted, to cater for the large numbers of people from one African country working in another. Cameroonians working in Nigeria, people from Burkina Faso and Cote d'Ivoire, and so on. He said there are millions of them, millions. And there are ways of sending money, sure, across the border. You can carry it yourself. You can get a friend to take it, and so on and so on. And often that works fine. But if you need another method, I've got one. If you need another one, where it can be put into digital, sent across the border, and taken out of digital. Okay, he's not alone in doing any of this, but MFS got an early start. Its record of growth was quite remarkable. In his annual reports, or his blogs and things, he told everybody how many million customers, no, not customers, million people he had linked up in this fashion. And it went up from 50 million after a couple of years to 100 million to the recent figures, 200 million. Not necessarily all his customers, but the people who could use this service, because he had linked up the networks in various countries, across various. One of his big, and the other thing he was doing when he did that was, of course, joining up the networks of agents. So the agent for Worry in West Africa could pay out something that somebody had bought in wherever. And, 200 million. I'm sure, again, we know he's not alone, but he got ahead. Okay, the other thing he did, of course, which again, very common, he made sure that all of this, as he expanded to 200 million potential customers and more, the technology that worked was feature phones and USSD. Okay, you didn't need a smartphone for this stuff. Although, of course, you could do it with a smartphone if you wanted. In effect, Okuju had said all along that the people on the ground gave the fintech experts the lead regarding what made sense to them. And the smart experts respected this and devoted themselves to extending what is most useful about mobile money to the people themselves. I would suggest, and I've said it before yesterday, P2P transfers remain the lifeblood of mobile money in Africa. And poor people are clearly willing. A lot of people object, oh, you have to pay fees for this, and it's somehow wrong. They shouldn't have to pay. They're clearly willing to pay the fees imposed for access to an additional means of nurturing social relationships of mutual support. The poor people are not, if it's useful, people will pay. If it's useless, then that payment becomes gouging. Okay. The Walla company, that's the second company. I don't know whether you've heard of it. It's gone bust. The Walla company was founded in 2015 by an American, Tricia Martinez, with the aim of encouraging people in Africa to adopt a blockchain-based cryptocurrency, which she called Dala. Walla and Dala. Martinez's introduction to the continent had taken place some years earlier when she set up an unconditional cash transfer scheme connecting caring individuals in North America and female subsistence farmers in northern Uganda. So you could send your money to a known recipient and track what they did with it and all sorts of things. She discovered that the rural recipients did not, and this was her words, she wrote endless blogs, so she never turned up at the 2018 conference, but she wrote endless blogs at the time, and you can follow it all there. She discovered that the rural recipients did not know how best to store the donations they received, and that this deficiency also affected people earning wages in Kampala. The latter understood that keeping their money in bank accounts cost too much, but knew of no sensible alternatives, so they were keeping it under the bed, she said. The poor people in the countryside, the same thing, but they had no prospect of access to bank accounts. Martinez then commissioned a financial literacy app, which of course means you're restricting this to smartphone users right from the start. She commissioned a financial literacy app claiming that it soon had 100,000 takers in Uganda, wanting to learn the lessons the app imparted in their own time about financial literacy. One lesson was that existing forms of money, and she said this openly many times, existing forms of money in Africa, including fiat and mobile, but also older forms of money, were all broken. Now, that's the disrespect. I mean, it's all broken. Because using them was too expensive for Africans. She said, which is true, the fee on P2P transfer using a smartphone can be 50% in some cases. At least she claimed that. Martinez thought of using Bitcoin as the replacement, but realized it was of little use as a means of exchange, as we all know. Her initiative had to wait for Ethereum to become available, which was 2016, was it? So she launches this company 2015, 2016, 2017 is rushing to get into business. And her Chicago-based tech partner, I think that's probably also significant. This guy was in Chicago. He developed Dala on the Ethereum system platform in 2017. Once for use on the Wala app, the system was launched in South Africa, where the company now had its headquarters, in Zimbabwe and Uganda. I can tell you it disappeared totally without trace in South Africa and Zimbabwe. And Eddie's going to explain why, with respect to Zimbabwe. It just made no sense whatsoever. The rush was then on to develop a worthwhile ecosystem. You know, now you've got your cryptocurrency, so what, and you're encouraging people to, what can they do with this? What can they buy with it? What can they sell with it? It needed governments, departments, merchants, and service providers who would accept Dala as payment. It needed employers who would use it as pay, and financial institutions that would convert Dala into fiat, at least as an interim measure until it gained sufficient trust, and she was again one of these people, it's going to replace fiat entirely. Ordinary people with the Wala app also needed to be incentivized to use Dala for the limited ends available at the early stages of this process. This was done by paying them in Dala for signing themselves up for this app, for signing themselves up to take Dala, and signing others up to use you were encouraged to get your relatives and so on to sign up, and you got rewarded with a small amount of Dala on every time you did all this stuff. So this was done by paying them in Dala for signing themselves and others up to use the currency and working through the financial literacy exercises on the app. The Wala company, of course, had to pay for these recipients to convert back to fiat, since there were so few initial uses for Dala. Wala and Dala were in a state of collapse by the time of our conference in 2018. Martinez didn't respond to our information, and the company's chief technical officer attended in her place. We later discovered that Martinez had been in Silicon Valley at the time, desperately and unsuccessfully trying to raise the large amount of venture capital that would have enabled Wala to achieve proof of concept quickly and make a rapid and safe sale of the company possible. That was what she was clearly trying to do. It was the Silicon Valley model. Get in, she describes herself as an impact entrepreneur. Get in, make a big difference, prove your concept, get out, sell it at a huge profit, and move on. That was the story. In an interview at the time, she said she was an impact entrepreneur, someone whose mission was a serial one of disrupting established practices with new innovations and moving on. She blamed the crypto winter that started in 2018 amongst Silicon Valley investors for a failure to lure investment then, but it would seem fair to say that the model of fintech innovation she employed was equally at fault. Poor people everywhere, anywhere, including Africa, clearly don't like being told, in deed as well as word, that they are financially illiterate and need to abandon everything they know and trust for an untried system that would make possession of a smartphone the prerequisite for participation, and would remove all the elements in their monetary repertoire, save for a crypto they don't have any grounds for trusting. The people were right, of course. Wala had no chance of building the ecosystem needed for Dala to triumph in Uganda, and as I said, it made no impression whatever in South Africa and Zimbabwe. Ugandans rewarded in Dala for signing up soon figured out how to game the system, of course. If you're being rewarded for signing up, then sign yourself up 10 times using fake IDs. Get all your buddies to sign up and so on and so on. And you get rewarded for encouraging them. They then cashed out the dollar rewards at Walla's expense. Okay, now Jeremy, I turn to you, or your company. An example, now this is respectful upgrading. I said at the start, you can try and upgrade. You can tell people, what you've got is not adequate, you need another step up. An example of this is provided by the company Inclusivity Solutions, whose CEO made a presentation at the 2018 conference. Jeremy made it clear then, if you don't know him, he's there in the shirt, the checked shirt. Made it clear then that he was aware that many low-income people in Africa would not place the idea of paying for insurance, the service that his company wanted to provide, for which his company wanted to provide digital facilitation at the top of their priority list. That many people, he said that, he understands. This is not top priority for many people. This observation, and he also said that they had reasons for doing this that were by no means trivial or simply mistaken. They weren't just wrong. This observation put us in mind of Viviana Zelitz's well-known, excellent study of how people in the United States resisted the idea of taking out life insurance. Her topic was life insurance. His it's only part of what Jeremy's doing. People in the United States resisted the idea of taking out life insurance until the second half of the 19th century, and that they objected to the notion of getting a monetary return on death on a variety of grounds, not least moral and religious ones. And it's a fascinating book because it goes into the fact that life insurance agents persisted from the last part of the 18th century to the middle of the 19th century and began to make headway in selling their service once a critical proportion of the population had moved to the growing industrial cities, where you didn't have this network of kin all around you all the time. As Zelitzer said, the agents also had to put in a great deal of effort, the life insurance agents had to put in a great deal of effort into acknowledging and at the same time modifying potential customers' moral sensibilities. They almost had to become missionaries to teach them a new notion of religion. They had to take these sensibilities, the people had to take these sensibilities on board as their own. So Jeremy expressed a considerable measure of respect for people's skepticism about insurance, but also persisted in the belief that a range of insurance products, in the first instance, insurance cover for hospitalization, were of benefit to poor people in Africa, regardless of their own estimation of these services and their own practices dealing with illness, accidents, and death. But the fact that he was not deterred implied that he had to find a way to introduce the hospital cover plan to people without requiring them to invest in it in monetary or other ways. He had to find a way to make the service available to people if they needed it without obliging them to spend a lot of time contemplating the principle behind it. The tactic he followed was not original, as he will readily say himself, but had been used several times before, for instance, by the MNO EcoNet in Zimbabwe, which it attempted in 2010, after 2010, to set up a system in which it paid customers insurance premiums for them as a loyalty reward for buying a minimum amount of airtime from the company per month. Jeremy wrote a report on EcoNet's scheme while he was head of the South African-based Finmark Trust and was aware that the company's efforts had not been problem-free, EcoNet's efforts had not been problem-free, notably when the insurance companies in Zimbabwe, to which EcoNet paid the premium on behalf of its customers, failed to honor their claims on account of administrative and other difficulties. So the system was inefficient in some respects. Inclusivity Solutions had to put considerable time and effort at the outset in developing a foolproof technology to act as an accurate information link between MNOs and insurance companies in Rwanda and Kenya, the two countries in which the company embarked on its services. And it also had reinsurers in the United States, all of whom had to be connected up. Despite this, as Jeremy told us in 2018, the service was relatively slow to take off in these countries. During the company's first year of operation, it recruited no more than first years of operation, it recruited no more than 70,000 customers, and only a few of these were customers paying the premium themselves, and therefore getting better hospital cover than those getting the service as a reward. Inclusivity Solutions managed to expand into Ghana after the first year, but the main stimulus to growth was the COVID pandemic in 2019-20. With the prospect of increasing numbers falling victim to COVID and needing hospital places urgency, popular hesitation about hospital cover began to dissipate. And the numbers of customers increased tenfold, if I remember this figure correctly, Jeremy, in this period. Although many still used only the insurance available as a loyalty reward. But any ambition to achieve universal coverage in the three countries has a very long way to go. You need me to stop, don't you?
Well, I don't want to interrupt. I mean, we could, why don't, you know, it's,
No.
take a few minutes to,
Oh.
yeah.
Ah, okay.
Yeah.
Lending to poor people is never easy to sustain, which I think is an interesting little case study that came up at our 2018 conference. Soon after South Africa's 1994 transition, Nelson Mandela asked the leaders of the banking industry to end credit apartheid and make loans available. He demanded, in fact, that they should end credit apartheid, make loans available to the mass of black South Africans. The bankers refused, saying that the cost of administering large numbers of small loans would be prohibitive. This opened the door to a phalanx of micro-lenders who made predatory loans and perfected the means of ensuring repayment via stratagems such as garnishee orders. Take it off your salary before you even see it. Aspects of this system remained in operation for a long time, prompting, and this is not somebody who's trying to he's trying to correct the predatory lending that's going on. This prompted a young South African innovator, Sechaba Ngwenya, to try his hand at ameliorating the predicament in which the country's poor black citizens found themselves in the second decade of the 21st century. In this regard, of course, he knew that some large South African companies were aware that their workers were being compelled by manifold demands on their pay packets to take the notorious payday loans. He knew that from unscrupulous micro-lenders, and he knew that these companies, big companies, some of them, were considering the possibility of making loans to their workers themselves. Ngwenya's plan was to offer his expertise in a very preliminary form of credit rating to these companies, thereby helping them to establish how much and how often they could responsibly lend to particular workers. He had designed, he told us, an algorithm by which to gather information on workers who signed up for the scheme and gave consent to have their financial records and, for instance, their mobile phone usage monitored by his algorithm as a means to calculate their credit worthiness. He succeeded in securing one plant operating as part of a very large South African company, South African Breweries, incidentally, as a client. And several hundred of the plant's workers agreed to participate in his rating exercise. He claimed that his system worked well, but that despite all efforts on his part, he was unable to find, at the end of the day, he couldn't find other companies that were willing to take him on as performing the same role. The companies he approached did not regard extending credit from their own resources to workers to be part of their core business, and several apparently told him that the technology he deployed would soon be overtaken by that being developed by the larger international credit rating agencies whose presence in South Africa was growing rapidly. Ngwenya explained then he'd come back to South Africa to attend our conference because he told us that he had been forced to conclude in 2016 that his company, Creditable, had no future in his home country, none, and that he should take his expertise and algorithm to the Far East. By 2018, he had established a new headquarters in Singapore where he was trying to interest banks in investing in his company's intention to work with companies and their workers in Malaysia. Why? Ngwenya's motive for becoming involved in the extension of credit in South Africa was clearly very different from that of the micro-lenders who preyed on black South Africans, trying to take advantage of the end of credit apartheid. Yet his attempt to restore a measure of dignity to workers in need of loans in order to meet their obligations was unsuccessful, ending more precipitously than the far less worthy efforts of the predatory lenders. Okay, let me stop there. I won't go into we can discuss. Okay.
Well, okay. So thank you very much, Professor Sharp, and for these excellent presentations this morning. Now we are going to have a tea break, and we will return at 11 to hear a presentation from Mr. Leach. And then after that, we'll be able to have, I'm sure, a very rich discussion around these issues of platforms and business models and visions, and it should be very interesting. So thank you very much for those great papers this morning. Off for the tea break now. We're not coming back from the tea break yet? No. All right. Welcome back from the tea break, everyone. Our next speaker is Mr. Jeremy Leach. He's the Executive Director of Inclusivity Solutions.
Thank you all. And I'm thinking after all these kind of different frameworks and such like, I should have had more frameworks in my documents. I was saying earlier, I haven't seen those for a while, but it's good to see that. So this presentation I'm doing today is more of a kind of update and a case study rather than going back to the theory, which we covered a bit in the previous session when we looked at insurance compared with other kind of financial products and the challenges around that. So this is more based on kind of John about an update of what's kind of happened and some of the changes, and as well as some reflections. So sadly, no kind of frameworks this time around. So the agenda today, it's going to test my eyes over there. First, just there's a few hidden slides as well, which will be shared on the kind of full deck. One is just talking about the size of the inclusive insurance market and talk a bit about that. Introducing inclusivity solutions and an update, and talk about the benefits of insurance and a case study from some of the work we've done in one of the markets. And then overall some lessons learned and concluding thoughts. I probably need a counter so I don't talk too much on that front. So kind of firstly, if you look at the inclusive insurance market, this basically gives you an idea of the kind of the size of the overall challenge from a Center for Financial Inclusion kind of study, where again we're looking at, it really stretched my eyes there. So 3.8 billion low-income customers in emerging markets. So typically the lowest 60% of kind of income, 2.5 billion in the middle to high-income customers in emerging markets. So again, trying to look at the kind of sheer size of this market. And what we know overall is that penetration of insurance is incredibly low. It's typically, if you look at the FinScope surveys, around 2 to 5% of the adult population has any insurance, with exceptions around South Africa, where it's around 40-45%, mainly due to funeral. If you look at non-life cover, then it's actually pretty low. If you look at an overall population, I think Zimbabwe is actually one of the highest penetrations, around 26%, if I remember correctly. And then, again, driven by funeral in Kenya after that. But otherwise, it's generally very low, misunderstood, and not appreciated. And yeah, Dario Kuju, funnily enough, Memphis Africa, is a good friend of mine going back years, and actually are a minor investor in us as a company. So there's a lot of alignment around that. But he once told me from his experience in Benin, is that insurance is like a tax that you pay and don't expect anything back. And sadly, that's been the case in most of these markets, because by design, if you look at them all kind of retail products, are typically compulsory third-party motor, where clients are compelled to pay, and the insurers may or may not pay out. And they've almost kind of, the insurers have undermined the insurance experience and undermined the trust, which is kind of why I focused on insurance, thinking it was the furthest from the tipping point when I was at Finmart Trust. And it still is furthest from the tipping point. There's still major challenges in the insurance sector. So talk about us. So we'll talk about vanity kind of headlines. We've reached over 1 million kind of customers. I don't like this kind of statistic, but we've issued over 6 million policies. It's kind of a bit of a weird statistic in my mind, but it gives you an indication on how many policies we've issued over that time. We're in 6 countries at the moment, with another 3 to be added by the end of the year. Kind of 15 plus kind of partners, and that's a bit out of date, but they're continuing to grow. What we are, and I'll talk a bit more about that now, is we're basically focusing obviously on reimagining the insurance space, so leveraging technology, and beyond that we provide additional skills to help expand out. I guess our strength and our passion is the broader inclusive insurance space. So we've got a lot of experience around that low-end space, but we also realize you need to be a multi-segment player. So we've got products right through the kind of income spectrum to the kind of the middle income space as well. I did this initially, then I brought it back. This is basically your typical archetypal value chain for insurance. Much as I'd love to be able to go direct to consumer, the sheer cost and challenge of that is huge. All the direct to consumer models that I've seen as insurtechs have basically fallen over so far. So we still believe we have to work with distribution partners on the far right-hand side. And we'll talk more about what those distribution partners are. As insurance is a regulated product, we obviously have to have a risk carrier and insurer to underwrite those policies. And that's also one of the big challenges we face around being agile and experimental, is it's very quick of you to change an app, but being a regulated product, it means it's tougher to be able to kind of be agile and experimenting around kind of products. And then on our side, as an insurtech, of course, we have a technology platform that's end-to-end, supports omni kind of channel sign-up, SMS, USSD, WhatsApp, call center kind of agent. Interestingly, we had an agent-based model which we were using, assuming they would have smartphones, so we can do more of a smartphone-based model for agents in Côte d'Ivoire. None of them had smartphones. So this is agents. So they all use USSD for the agents as well. So real omni-channel, and often use our partners' user interface as well. Then full digital administration right through to claims processing as well. They can initiate the claim, process the claim all digitally. But beyond that, we realized that technology is only an enabler. It only goes so far. So we've actually built out the skills beyond that. We have skills in research. We do quite a lot of HCD kind of research, have done over a dozen countries since we kind of set up. We do product development and pricing right through to submitting the actuarial note to the regulator. We do a lot of experimentation. We do a lot around data science, and I got a fright now when our head of data science, twin brother, was here today, where Ajiko runs the data science side on our team. So we do a lot of work to really understand the needs of the customer, to experiment around the customer journey, and leverage data to understand the needs of the customer, how they're engaging kind of with us. And we've had to build out those skills because our partners don't typically have that or have that understanding because they've been focused on the upper end of the market. In terms of our focus, we've also joined the embedded insurance hype. You know, I find it a little bit strange because embedded insurance is pretty much where insurance came from in the early days. What is, mortgage insurance or insurance credit life, where you have insurance attached to the loan? That's embedded insurance. The shift has been more around embedded insurance 2.0, is around the digitally enabled model. So it simplifies adding insurance to another product or service. That's all it is. It's not a new term. It's not a new approach. It's really about the digital engagement with linking products, insurance to other products or services. So it's again, but there's a big hype around embedded insurance about the size of the market and the opportunity. So these are some of our partners across telcos, kind of financial services and digital platforms, including kind of MFS Africa. And we're quite excited about where that would go to with some kind of challenges. Where we are compared to where we were previously, we're now in 6 countries. 3 should be added over the next few months with 15-odd plus partners. Previously, I think at the time, we were at 4 countries and 7 partners, including the insurers. At the time, we made serious mistakes, and we'll talk a bit more about that later. We had 3 major partners, which we called supertankers, because if you know the idea of a supertanker, for a supertanker to turn, they have to start to turn 7 kilometers before the space where they want to turn by. And we dealt with kind of players like Equity Bank in Kenya, Airtel in Rwanda, Orange in Côte d'Ivoire. We're over 3+ years, they're still trying to implement some payment improvements on that kind of basis. We can touch on that a little bit later. So again, we've decided to wean ourselves off the initial kind of 3 and have been aggressively focusing on the BD, and we're seeing some of the benefit coming through that, as you saw on the previous slide, and this one as well. We've also extended our product suite significantly. So I guess our previous ones were primarily hospital cash, life products broadly, and as you can see from the range, we've now got a full range of products which are all plug and play. We've also industrialized our platform essentially. So basically, we've now opened our APIs. So any distribution partner can log on, or not even log on, can go to our website and essentially create their own products, leveraging our APIs, which again simplifies things dramatically. We had one neobank sign up basically create 2 products using our APIs within an hour, which we're still a bit astonished about. We didn't expect it to be quite so easy on that front. In terms of changes, in 2021, we made 3 major strategic shifts. One is on the sales strategy. We decided we've already proven the platform, the capabilities in the back end, and we weren't making much progress with our supertanker kind of partners because of their payment challenges. So we aggressively focused on the BD. We increased the role in the value chain to control the sales cycle more. We got our own kind of agency license in Kenya on that space, which allows you to sign things up a bit quicker. One thing we realized as a SaaS kind of type provider, decision-making from partners to sign you up is complex because then they have to go through a whole kind of SaaS evaluation and approval of technology platforms. Whilst as an agency license, agency is bread and butter. They can just sign up an agent pretty much within hours, give or take. So again, by taking on an agency license, it was easier to operate. We've also focused again from larger to smaller partners. That's enabled by our open APIs, where before, and this is how technology has changed, to sign a partner up, the technology and integration was painful and problematic and take weeks. Now the open API, they can basically do it themselves within hours. So again, it allows you to then start looking for smaller players kind of in the market. And I think one thing that's kind of clear, and we heard a bit about this morning, is that while you see a much larger range of digital platforms in Africa, so many of them are subscale compared to Asia. Asia, you have pretty large kind of platforms which you can really get to scale relatively kind of quickly. Unfortunately, in Africa, you may have a number, but their scale of them is limited, and they also don't necessarily have the kind of frictionless payments, which I'll talk about kind of in a minute. But again, open APIs allowed you to sign kind of partners up quickly and kind of easily. Product strategy, again, focus on embedded insurance. We were kind of doing it, but I guess it's the maybe more strengthening that in terms of the platform side, and support plug-and-play products where you can basically kind of work with. And again, we've seen the impact of that, of basically adding new partners, growing it by kind of quite significant growth over the last kind of few months, which is positive. I'm quite excited by that. So in terms of the benefits of insurance, again, John was talking about that freemium type model previously. So there's, I guess, embedded insurance covers different type. And as I said, embedded insurance is where you're basically linking the insurance product to another product or service, whether it's credit, whether it's remittances, whether it's e-commerce, whether it's booking your flights in an easy way. And this basically can be done at no cost to the customer, or they pay a kind of small amount and they can opt into those kind of products. So some of the benefits of insurance, if done well, it can attract new customers, retain existing customers, drive new revenue streams, which is obviously a priority for many companies, enhance efficiency and customer satisfaction, improve brand and social impact, and drive more profitable consumer behavior. So I think there are benefits, and we've been trying to prove that in our engagements across a number of different providers. And I think we are seeing some indications that if done well, you can see those kind of benefits. And the challenge on a lot of the continent is it hasn't necessarily been done well for the customers. So this is a case study of MFS Africa, so it's very timely that you were talking about them this morning. So we partnered with MFS Africa, who are focusing around the money transfers from country to country, and we particularly focus with MTN in Rwanda as our initial kind of test case. So what we did, designed a loyalty type product to incentivize people to send money to someone in Kenya, Tanzania, Uganda, or Burundi. The problem to be solved is MFS Africa only makes money if clients are using their platform to send money transfers. And it's both a priority is the sum that's transferred and the frequency. That was their priority. And if you don't get transactions, they get no money. So they're very incentivized around driving transactions. So we designed this kind of product to increase remittance transaction values and the volumes, and they ended up covering the cost. And we actually did quite an exercise to really understand what would be the impact of that, where we compared data kind of previously and then compared it to after the, I think it was like 6 months or so after the launch. And we saw that there was a significant increase in the average transaction amount per month from previously, around almost 20% increase in the average transaction amount because of the insurance. Average number of transactions were close to 10% increase, which again is quite kind of significant. And the number of new customers per month was over 109%. Certainly part of that may well have been impacted by the COVID and focus on digitization. We recognize that. But when we've tried to isolate that, we've also seen the kind of the benefit from that. And also reduction in the lag between transactions of around 38%. So when you look at those kind of figures, even individually, they're quite significant. And we've been able to try and isolate it to ensure that it was specifically due to the insurance as far as possible. So again, positive indications around how insurance can drive benefits for your partners and of course the end customer. So going on to some lessons learned. Well, products, they need to be simple, affordable and relevant to the market and cultural drivers. So my favorite anecdote, which I think I probably overused last time, was when I was in my consulting days when we saw that Vodacom and Tigo had launched funeral insurance in Tanzania. Now, Vodacom makes significant money from funeral insurance in South Africa. Tigo was making a significant amount of money from funeral insurance in Ghana. And so both of them independently thought, well, let's roll this out to Tanzania, because you want to replicate what you're doing. Isn't that the main aim of companies? You prove something, then you replicate it. Well, when they launched in Tanzania, clients are ringing up saying, why are you cursing us? Why are you wishing us dead? That's clearly not great for their brand. So again, the challenge is with insurance, you need to be able to adapt it to the particular market. And we've also heard, again, a couple hundred years ago, or even so, life insurance was forbidden by the church because it's taking things into your own hands rather than leaving them with God. So obviously you have to recognize the cultural drivers per market and adapt products to those requirements. And they need to be simple and obviously kind of affordable. And I remember when I was still at Hollard, I had an insurance policy document. I took it to our head of legal who used to be at the Ombud. He couldn't understand this document either. So they've been designed to be so complex that they're unintelligible. So how are you going to get kind of take off from there? Again, focus around benefit design. You want to simplify this in a way where you can communicate simply and via SMS, so limited or no exclusions. Where again, I've seen products for less than $1 a month, very focused on the low-income market, where they've got an exclusion for hang gliding. I mean, come on, how many in that target market are going to go hang gliding? They just don't. I don't think a lot of the insurers think about it. They just look at all the risks, and then they add this long list of exclusions. So again, simplify that. And distribution. Yes, it needs to be digitally enabled, but I think we've proven that it's not sufficient in and of itself. There's not sufficient demand that if you just put it on a platform, it's going to take off. So you need to also support those kind of analog models, those face-to-face models, and the call center models, which have been proven in some markets. So you really need to think through how to engage with the customer. And so much of insurance is around distribution. You can almost ignore products and benefit design to a certain extent if you have effective distribution. But overall, the critical building block for insurance is frictionless payments. The aim that once you make a decision to buy insurance, that the premium will go off without any effort. Now, if I go back to our initial supertankers, our major problem with them, despite fantastic brands, over 20 million client base between them, was the payment issues. One, we didn't fully know this when we launched them, none of them had recurring payments, frictionless payments. So it's all push payments. We knew push payments doesn't work for insurance. It works for airtime, electricity, remittances, because if you don't pay, there's an immediate repercussion. If I don't pay the electricity bill, my wife is going to be making me cook in the dark. There's an immediate effect if you don't do something. Insurance, if you don't pay, the only impact is, and it's catastrophic, is you don't have the cover when you most need it. But everybody discounts the future, so they don't think about that event, and other priorities come in. So we had push payments model, which didn't work. We'll talk more about that next slide. Secondly, we had major payment issues. So everybody who's worked in Kenya knows kind of Equity Bank can be an interesting, challenging bank. But we had 90% payment failures using the digital channel. On average, for a client to pay their premium, and they have to do it every month, they have to attempt payments to make 3 to 5 attempts to make a payment. Can you believe it? That every time you make a payment, you have to try 3 to 5 times with it kind of timing out and all the problems coming through. Apparently it's the same for Equity and Kenya Power. So it wasn't just us. We thought it was for a while. But again, if you don't have frictionless payments, you're not going to drive kind of take off. So frictionless payments is the core to insurance. The problem is, in many cases, it's not been available. Partly it's by design. So in the early kind of days of mobile money, this is back to kind of Fundamo and Hannes van Rensburg, as some of you may know. And I remember having discussions of him at the beginning, and the way they built their platform was to give control to the customers. Essentially, they wanted a push payment model because there's so much distrust of money going out of their account without people understanding what that's for. So the platforms were designed for push payments on the mobile money kind of platforms, from Fundamo kind of onwards. And that's still the case. So even now, we basically having to work with our partners to try and enable those kind of recurring payments of kind of mobile money platforms. And the problem is, it's been set up so much for the push payment. Now, shifting the platform to recurring basically means that you cannot get those high commitment products of insurance kind of savings or pensions going effectively, which is kind of so critical. So again, over 3 years, we're still fighting to try and get recurring payments done. So it's by design. Secondly, it's by regulation. I think it's started to change now. So in kind of our regulation side, the Central Bank of Kenya was concerned that Safaricom's M-Pesa was hosted in a trust account. So they didn't have that full visibility of a T account. And so they were concerned around the risk, so they didn't allow recurring payments, debit order type functionality of mobile money in Kenya. That's started to change now, thankfully, although it's still complicated. In Tanzania, an Access to Insurance Initiative case study highlighted that the insurance regulator banned recurring payments because one competitor to us, either Beamer or Vodacom, had basically were able to do recurring payments, but the client couldn't opt out. So they're basically, in Hotel California, they're having these recurring payments, but couldn't opt out. And the regulator said, no, that's not acceptable. And so they basically banned it as a model. So again, you've got those kind of regulatory challenges. And then some of the rules of the game, because of abuse of ringtone providers and others, where they're always harassing you, adding those kind of recurring payments onto your phone. I had to opt out a couple of them recently. That they said, we're not going to allow any recurring payments for VAS providers, whether it's insurance, which is a high-value product, or a ringtone. So we know we're dealing with now Airtel, who basically at one point had said that across all their markets, they were not going to allow recurring payments, which again means you're limited to the products that you can launch. So in terms of the impact of that, this is just looking at the difference between push payments and recurring payments. But basically, there's a close to 100% loss of income because of that. Because you're basically lapsing so significantly, because clients may say it's important, but the reality if you're a push payment model, every single month you're going through that point, do I want insurance? Do I need it? Do I have enough money? Can I pay? Am I willing to pay 3 to 5 times? Attempt to pay 3 to 5 times. We know there's a huge drop-off in that case. So again, there's no business case for insurance if there's a push payment model now. So concluding thoughts, and I'm probably over time. One, as I set out, as I mentioned in 2018, I think inclusive insurance in Africa remains the toughest financial inclusion vertical. And there are major challenges to scale, whether it's around the limited digital platforms in the market, if it's the lack of recurring payments, frictionless payments in this space. Impact can be really significant if done well. But again, the challenge is if done well. There's so much bad quality insurance products out there that just undermines the trust in the market. Embedded Insurance 2.0 certainly offers significant potential. As I mentioned, I don't think it's anything new. But again, I'm in that point around the distribution opportunities are still early days, unfortunately. And I remember a nice little case with that Irrational Labs spoke about in that the main driver of retirement funding in the US was essentially the default option, that when you get an employment contract, the default is you have retirement funding unless you opt out. And it wasn't the investment in financial education or product design, it was the whole point around default. The default is to pay. Otherwise, you have to opt out. So again, that's the challenge of driving a voluntary insurance product, is it's not necessarily top of mind. My other big concern from a regulatory point is I'm worried that embedded insurance, even though 2.0 could be the next mis-selling scandal. Because basically you're including a product automatically in another product or service. And if not done well or not communicated well, that's a recipe for abuse. We've seen that happen in South Africa where, credit life, you're basically, typically covers death, disability, and retrenchment, but you're selling credit life to self-employed or people who aren't formally employed. So why are you selling retrenchment cover to them? I think the same thing was in the UK with like a £5 billion fines in that area. So there's a real danger that this embedded insurance hype can lead to significant kind of whiplash through mis-selling. I think overall though, I think most insurtechs, and I include ourselves in this kind of space, are finding it tough. We are still being funded by shareholders to a large extent. I'm hopeful that will change, but we still have a long way to go to really kind of prove profitability, particularly without a strong strategic kind of a distribution partner as a kind of shareholder partner. Because without that built-in distribution, it's tough to get to scale. We've seen that in Polis in kind of Asia as well, which basically was, had its own built-in kind of distribution. So I think that's going to be one of the challenges in the insurtech space going forward, is saying, unless you have that big scalable distribution partner where you can basically offer services to, like MTN IO or Standard Bank's now Mobisure, it's going to be pretty tough to get there, or become an insurer in your own right with the whole capital requirements around that. So that's what I've got to say. So sorry, no different frameworks, but hopefully that was an interesting update.
Thank you so much, Mr. Leach. That was a fascinating, I think, example of a persistent barrier, is the difficulties of scaling insurance, and not just in Africa, but in other places in the world as well, for a variety of reasons. All right, I have the microphone here, so we have until 12:30 for discussion now, so I'll pass it to Sheila first.
Hi, thank you for your presentation. I have a question about crop insurance. I don't know if I'm talking to the right person about that, yeah? So there was a program that I was a part of, which was being funded by WFP, where there was some large-scale adoption of climate-smart technologies in a very arid place in Kenya. And it was a requirement that the farmers had to be insured. And so we had a private stakeholder, R3, come into the picture. And the project ran for about 8 months, I believe, in the year that we had the most severe drought in the region. So a lot of the crops that they had attempted to grow failed. And R3 was meant to come in and provide some kind of compensation, which they did. But my question is, who does or who determines the amounts of insurance that these farmers are going to get? Because the amount that they were given was not even close to what they would have gotten. And is there the intangible things that would happen with such a failure considered? Because it was a catastrophe. They wasted time, they wasted a lot of these issues. So I guess my question is, what your opinion is, your honest opinion on this whole crop insurance, disaster insurance, catastrophe insurance.
Should we take 2 or 3 questions at a time, perhaps? We can send the microphone around to our for another question.
Let me just say hi to everyone. First of all, I couldn't join you yesterday, but I'm very pleased to be with you today. I'm Hannah Dawson from Wits University in Joburg. The first presentation feels like a long time ago now already, but I had 2 questions for Jonathan and Shanae, I think it is. The first, well, So I wanted to say I appreciated two things that you said. One was the difficulty of counting and the broader challenge around good labor statistics in much of the continent. South Africa, I predominantly work on South Africa, but have been in recent conversations with people around actually what we can actually say about what we know and don't know about labor markets in the broader sense, including not just paid waged employment. So I appreciated that, the real challenges of counting all types of labor and work, paid, unpaid, informal, formal, not just thinking about digital livelihoods, as you put it. The other thing I appreciated was the way in which you spoke about platform livelihoods and breaking it into working, trading, renting, creating something I say in work I'm involved in around gig work and thinking about digital work is we focus in on one particular element of that to the exclusion of a lot of other types of work, but I think you've outlined this in ways that are useful. So with those comments in mind, one of the conversations that happens a lot in the working element of the platform livelihoods is a kind of conversation of to what extent are digital labor platforms actually creating new jobs, or so you can think of an obvious example, for example, food delivery. Of course, this looks slightly different in an African city versus a city in another part of the world. These have been here for a long, long time. There's nothing new about it. Are platforms creating new numbers of particular types of jobs, or are they rather just subsuming many existing types of work into platforms and taking, in some cases, a very significant share? If you think of something like Uber, taxi systems have operated for a long time, and now a platform takes up to sometimes 30% of that share. So there's this debate happening within the one segment of your classification of 4 types of livelihoods. And I wanted your reflections on that, because I feel when you think of renting, creating, trading, and it might be that there's a differentiated response in some areas. So I'm just interested in your thought on that, which relates to also the challenge of counting, but to what extent are we actually creating new opportunities or seeing them being reworked in other ways? And then my second question was around cash. You spoke about how cash is still an important force in many African markets, and then said something along the lines of, well, we're working with this, and I wanted to ask, what does that really look like? If you're really grappling with the fact that cash is still so essential to so many African economies, then what did you mean by that? And then my third question is one that I think perhaps could go to all 3 speakers, in particular also Jeremy, which was something that, again, in the kind of digital labor platforms gig work that I am aware of, is being able to ask what all of this looks like if it's a global platform, a regional platform, or a local platform. You see this if you look at Fair Work's ratings of platforms on labor standards. There are differences, even in the South African context, between local apps versus global apps in terms of work standards. So the incentives are different, the sense of your value add are different. And so I'm interested in this broad landscape and in the countries you work in. Are there trends in relation to where the apps are developed, but also where they're housed? And I had the same question for Jeremy, because you spoke about Asia being different in terms of Africa being a space of subscale. My inclination is to say, well, one thing that makes Asia different is that a lot of the providers and the digital platforms are Asian-based. And I'm not sure to what extent the question of regional, local, global apps, how you see that playing out in the insurance space on the continent. Sorry, that was a lot.
Okay, to Jeremy. Is there enough data to inform where the customers or the clients are with respect to the insurance product that you're offering, considering that there is insufficient data to inform the product that you have? Yeah.
Should we have some answers and then we'll come back? Otherwise, it's too many. So we'll go to Chernay and Jonathan first, and then maybe over to Jeremy for some answers.
Sorry, are we going to do the...
Yeah, where is the microphone?
I think I'm wearing one.
Or you may be mic'd, yeah. Okay, go ahead.
Apparently I'm mic'd.
Yeah, all right.
So, but were we going to do the question about crop insurance first, or shall we?
Well, I was just thinking about moving the mic
Moving
closely,
the mic around,
but
okay.
that's fine. Jeremy could go first if he'd like. He has the question about crop insurance and catastrophes, as well as the question about data. Is there sufficient data to inform how his customers are doing with the insurance, as well as the question of global, regional, and local work standards also goes to Jeremy as well, I guess. So.
Cool, thank you. Some complex questions. So on the Kenya one, it'd be good to chat separately around this. But I mean, and I assume you're referring to kind of the index insurance type model where you're using kind of satellite or weather data to inform the kind of the pricing models on that. It's a really problematic area. For over a decade, there was a kind of I guess an example of a pilotitis, I think they used to call it. You know, pilots everywhere, but mostly subscale. And I think one of the bigger challenges that came out of it was basically the basis risk. There's quite a few other things, which is basically the difference between the experience and what the data is kind of showing. So there's a nice Swahili phrase, which I don't know, but it basically talks about the rivers of rain. So you have like one side you're in flood, the other side you're in drought. And that's exacerbated in hilly countries. If you look in Rwanda, you can basically see that, you know, one side of the hill in a very hilly country is kind of lots of rain, the other side again drought. So there's huge problems around using the kind of weather-based stations and satellite in terms of the experience kind of issues. And that caused major problems in terms of the issue. We also saw extreme range of pricing. I did a study that may be worth looking at. It's actually on the FSD Kenya website, which is the review of FSD's index-based weather insurance initiatives. It's quite an old paper, but I think the insights still stand. And what we found in the kind of the study, and we did the similar thing in Rwanda at the time, was a couple of things. One, from the pricing standpoint, you need to okay, it's different language. I think the worst aspect that I saw in Rwanda is we saw one scheme, again, the policy was issued relatively late, but they saw basically the premium was around 30% of the sum insured, which is not insurance. I mean, that's basically in 3 years, you've got the full kind of cover back. So again, there was a real issue in terms of the cost of delivering these type of models on that hand. Secondly, the basis risk in terms of the challenge. The experience on the ground was quite different from what the data was kind of showing in multiple cases. And the overall kind of recommendation that came out of that study was don't sell it to the small scale farmer. Because again, and there was a nice kind of example from an academic that, you know, index insurance could be the next kind of example of mis-selling scandals. Because of the challenge of offering it. So I think going forward, technology has improved, so we're getting much better from satellite kind of quality and base stations, but we've also seen a shift to companies doing hybrid models, leveraging that satellite data, the weather base station, but doing crop cutting at the same time. Pula is an example of a startup that's shifted into that model because they realized some of the real challenges around the index kind of based models, which was great in theory, but fell down in kind of practice. In terms of that cost benefit, I think we have seen a shift from, you know, selling it to the individual farmers to government macro-based schemes. Swiss Re is very much focused around that they only really want to be involved in macro schemes, which is either, you know, government-based schemes, and again, then it comes down to what they can afford to pay, and that then is the cost benefit between what they can afford on the premium side and the sum insured that they can pay out, which is obviously a kind of challenge. Or secondly, portfolio cover, where, for example, you're insuring the portfolio of a bank and all their farmers, and it's up to them to manage how that disbursement is made to their farmers in terms of write-offs and such like. But those models at least kind of, you avoid some of the challenge around the basis risk and experience kind of on the ground. In terms of the sums insured, That's a real tough question. I mean, insurance at the end of the day should be something that's designed for infrequent risks. If you're designing a product where the risks, there's a high frequency, so for example, drought every year, your premium is going to be extremely high and your sum insured is going to be pretty low. And unfortunately, from a consumer perspective, the client's going to say, if we don't get a regular payout, there's no value in the insurance, not realizing that the whole point of it is to be in place when there's a really catastrophic event. And so what that happened is you designed it in such a way that you designed it on a high frequency, so you give something to the client, but what you can give to them is going to be a lot lower than if it's on an infrequent event. So it's a longer story, but I think that study would be worthwhile examining. We chose not to go into index insurance because of some of those kind of major challenges, although I do see there's a role if you think through some of the design aspects kind of carefully. I'm going to take a different angle to your global kind of platform kind of angle. So we're a cloud-based platform, we use AWS. In Rwanda, there's data protection rules which require you to not to allow consumer data, mobile subscriber data to leave the country. I don't know if you saw, MTN were fined $7 million a few years ago for hosting their data in their Uganda regional data center. That's a lot of money for a startup. Well, a lot of money for an only company, $7 million. So they were required to deploy locally. That caused major problems. The local kind of cloud providers are not up to snuff. It's poor quality. Typically, they don't have the same level of stability and major concerns. So it caused real challenges for the end customer. So again, you have that trade-off between the focus around, yes, you want to encourage that local, as well as basically encourage kind of startups. And a number of startups that I know of will never be able to serve mobile subscriber customers in Rwanda because the cost and complication of deploying servers into a relatively small market doesn't make sense. So again, how do you manage those trade-offs? You want to leverage the efficiency and the cost effectiveness of some of these global platforms, but at the same time as managing the localization aspect. So I think these are hard choices to be made, and they need to be kind of thought through, and I don't have specific answers around that. I don't know about the local global thing in terms of those kind of those platforms in kind of Asia, but I know, for example, in my informal research of Uber drivers, many prefer the Uber to the other more local providers because they get paid more regularly, find security is a bit better, kind of, etc. But again, that's anecdotal. I haven't done the research around that. But I think there's some interesting debates around that. And you've also seen sad stories of local platforms falling over in Africa because they don't have the capital, which I think is also a major issue in the continent, is getting capital to the local providers, which I think has improved dramatically, I think, in the last decade. But it's still not where it kind of should be. So I'm hosting hold the mic. Data to inform products. I think there's a few things. In certainly the rest of Africa, actuaries will use what's called an ATS model, an actuarial thumb-sucking model, because you don't have that level of mortality data, you don't have the level of data we have in those sophisticated markets. So you're having to use kind of rough assumptions from WHO and other statistics to inform the pricing kind of model. And then on the experience data, we do a lot of analytics ourselves, but you don't necessarily have all the data you want. Quite a lot of providers don't collect gender data, for example. So it's difficult to then use that data for segmentation model because we use distribution partners kind of data. But it's probably a whole other story.
Okay. Can you guys hear me? Yeah, so on this topic of cash, I mean, Henny Bester once wrote an article about cash as king, and that was many years ago. And there are all these conversations about why cash is sticky. And a couple of months ago, I was doing some proprietary research for a global hedge fund that was looking to enter Africa, and they asked the question of, because we were saying, cash in, cash out networks is still going to be essential infrastructure, these agents as a distribution mechanism. And they said, okay, but when is the inflection point? Is it in the next 5 years or 10 years that Africa would go fully, with digital payments? And they're the usual arguments about why cash is sticky. If we think about digital payments and the infrastructure around that, internet connectivity is not always at its best, even if you're using a mobile POS application as a merchant. There's issues around, digital literacy, behavioral issues around, trusting digital payments providers and what that means. There are also failures with certain systems. So, you know, has the payment actually reflected? Who knows? There's a conversation about push and pull payments. You know, there's issues around fraud in digital payments, a whole host of issues, right? Which makes cash very sticky. I mean, we spoke to I said earlier, we surveyed, it was 2,500 retail merchants, very informal, small micro merchants in Kenya and Nigeria. Many of them accepted forms of digital payments, but, you know, 70 to 80% of their payments were still being received in cash, and that's a consumer-based preference. And if you think about it and you boil it down, it's like, why is cash so sticky? And I think there are two characteristics about it that have not been solved digitally yet. The first is that it's instant, so it's not going to take 2 to 3 days to get to your bank account if you're doing a funds transfer. You know, much of the existing payments infrastructure doesn't allow you to get payment and reflect settlement within, you know, 2 to 3 seconds, and the merchant can then give you the goods once you've paid. And a lot of that has to do with legacy infrastructure of payment systems in Africa. So there's the instant bit about it, but then very importantly, and it's what Prof. Sharp spoke about earlier, interoperability. So if you want to send money, but I have you know, I'm banking with this bank and you're banking with another bank, or you're with a mobile money provider, those, you know, different payment ways, they don't speak to one another. They're not easily transferable. And so I think a lot of what is happening now, not only locally, but also in the cross-border space, is around building interoperable payment systems. And we're seeing innovations coming out of, you know, Rwanda, Tanzania, elsewhere, TCIB. You know, there's even a lot happening in West Africa and for Africa as a whole region. But those issues around interoperability are really challenging. You know, many providers are still working within closed loop systems. So very, very, very difficult challenges to solve. And then I'd say lastly, just from a business model perspective, and I'm looking at it now, McKinsey did some research about mobile money economics and why cash in, cash out services or networks would remain fundamental to their business models, even though they're trying to sell higher margin digital payments products. And what they found was that if you reduce your key code transactions while increasing digital transactions, it actually hurts overall profitability. So the two revenue drivers grow together. And I think, again, it's the whole importance of that physical touch, the agent network. You know, it's used differently maybe in Jeremy's industry, but you were talking about, you know, making sure that the distribution network is possibly one of the more important things in your business model. So I hope that kind of answers it, yeah.
Okay. And then...
Oh, and the global local.
It's global local.
Yeah.
And,
I don't want to take too much from Jonathan, but I'll say two things on global and local platforms. Marketplace platforms are trying to enhance abundance at the discovery layer or the supply layer, right? And if you think about global platforms in say digital products and services that aren't captured by local borders, so everything can be done online. Abundance of supply, you can think about that expanding completely. And so those on the supply side who are offering the goods and services, it's, you know, there's always this talk about the kind of waged, or what is it, like a vicious spiral on prices to the bottom kind of thing. I think with with localized platforms, it's a little bit different because those goods and services are almost location-based. There's a lot of physical ubiquity around that. And so I think many of the local platforms are also built for the local context. And we've seen a lot of that happen in Indonesia with social commerce platforms, reseller platforms like Evermoss and others that are actually building, you know, the network around informal social networks within communities and village groups. And then rather using the marketplace platform or the reseller platform as a kind of layer on top of those existing groupings. So I find that local platforms sometimes lead to maybe better outcomes, or just because they're kind of built on the local understanding and nuances. Yeah.
There was one, yeah, you had another question about.
New jobs.
Are there new jobs?
Yeah, or are you just platforming what was already there?
I don't know. And nobody knows. And that's the problem. There's a fair amount of writing right now and a fair amount of research about gig work, you know, happening everywhere. And there are wonderful books about it. And, you know, whether you're studying, you know, Deliveroo in London or Sendi in Nairobi, you know, there are lots of good case studies. There are lots of good interviews with qualitative methods to understand the experience of being a gig worker. Some are happy, many are not. A lot of it depends on how differentiated your skills can be and how much you can command, whether you really are your own boss, meeting other people, you know, using the platform to find your market, or whether you're an employee in all but name and protection being managed by an algorithm, and whether your day is a high quality day or not. We know this, and we know this, I think, you know, the research community knows this because they are studying lots of individual types of gig work in lots of different contexts. I love all of that work. We did a lit review on this a couple years ago. It's at the Platform Livelihoods site I shared earlier. Where there's much less that's well understood is this enumeration challenge, like how many gig workers there actually are, and let alone where they're coming from, to your question of are these new jobs or not. You know, some anecdotes suggest that some people use this as their first job. I wasn't working before, now I am. Came out of school, now I'm a gig worker. But a lot of people are coming from somewhere and presumably are headed somewhere else. We need better data. And it's really hard to gather because I think, it's a bit of a slight to say this, and I don't mean this in this way, but I don't think that the national labor studies have caught up and do a good job with their questions to enable us to answer those queries of where people are coming from and where they're going. And if all you're doing is interviewing current gig workers, you never get a sense of who's left and why. So, and you always get the kind of survivor bias. The people who are still doing it think it's better than the alternatives that they could do, and usually will tell you that they're doing better than they were before. In many cases, they are, right? If they're coming from subsistence level, you know, casual work, like getting a steady gig driving a two-wheeler or a four-wheeler may be better. Those margins are very thin, you know, especially if you're renting the car or you're paying to use somebody else's car and you don't own it. You know, when you really sum up the hourly wage, it's not very good. And it's never going to get good because as soon as it gets good, the algorithm sees that gap and floods more drivers onto the road, right? So you're sort of stuck in this thing that makes it really not high quality work. That narrative's coming along, but needs a lot more data on where people come from and where they are going. And only once we have that are we going to be able to better understand where this part of the future of work sits into the development story and the questions we've got. We're trying in Indonesia. We're going to do this study in a little while. Hopefully next year we'll have it out for you guys. But that's only one market, and I really don't know where that data is going to come from. I want to say one last thing, which is the Fair Work data is excellent, right? It's a wonderful resource that they've built in multiple countries that gets at some of this, right? But because it rates the platforms as opposed to sort of traces individual users or users of the platform, it's not great at answering these questions about whether it's really creating new jobs or not. Somebody who's a better economist than me should be doing that study, but really counting whether these are creating new jobs or not would be a helpful thing to do. So I'm sorry I don't have a better answer other than it's a long way of saying I don't know, but we should know, and we don't yet.
Thank you. Okay, Professor Tinashe.
Okay, very loud. My questions are going to be confusing, so I'm going to apologize for that first. All right. Data. We're talking about people. That's the first thing. And for me, this is why a lot of these things fail, right? Because we're reducing societies to data points, to, what do they call them in economics? I'm forgetting the term, I wrote it down somewhere, but it will come back to me at a certain point. And when we're talking about digital payments, and we're talking about how the future of digital payments or digital money in Africa is, we're forgetting that there are multiple forms of money. There will always be multiple forms of money. There've always been multiple forms of money. When the colonial or imperial state tried to enter into Africa, it tried to introduce what they said was modern money, right? To reduce transaction costs, to facilitate easy international payments, or so they thought. But basically what it is was subverting forms of payments that had multiple purposes and that had worked by trying to impose their own for extractive purposes. And this is exactly what's happening with fintechs. And as long as fintechs don't realize this, they will never reach the so-called bottom of the pyramid. How do you bribe a policeman? I live in South Africa. I've lived in Zimbabwe. I'm not going to send him digital money to bribe him because that's evidence. So he's not going to accept that, right? And I've just given you just one example. There are numerous other examples in which digital transactions are impossible. So let's accept the fact that digital payments are not the be-it and end-all of transactions in Africa. That's the very first thing. Secondly, we talk about markets, right? Sitting in this virtual ivory tower with all of this technology, microphones, laptops, cameras, and everything. The market is out there digging somewhere for gold, right? Dirty, without any network, or toiling in the soil to try and get something from whatever it is that they're making, and they don't use the term market. So for me, that's the first thing. And when we look at them, we're going to them and speaking above them and to them, looking down on them and saying we're going to try to understand how this market operates. They understand themselves. Especially when we go and we say, these are poor communities. Don't get me wrong. I'm not saying there are no poor people out there. But my point is, to who are they poor? What is your understanding of their poverty? What about their own networks and, community connections? I like to use the term, the triple F of these communities: food. Where did I write that? I wrote it down somewhere. It has to do with food, education, and funeral, something like that. They've got these social networks that cover them. So there are points at which they may be without, but there are points at which these networks are harnessed to make them get something. And some of these poor communities that we're talking about have produced people that are sitting in front of you today, right? Without these digital platforms or everything that we're talking about. So the point I want to sort of hammer home is that let the communities speak for themselves. Let these communities tell you what their needs are. I, for one, despite having come from those communities, am actually so far disconnected because I've been corrupted by where I am now that I don't understand whatever it is that they need. So when we're talking about frictionless payments, Jeremy, for example, you're talking about them having to pay a premium of maybe, I don't know, just for argument's sake, $50 per month, right? This is just me speaking. I just took this figure out of the air, right? To sustain whatever premium that they've got, and they have to pay it on a certain date at the end of the month, right? And here we're individualizing these people. Some are living in communities that operate in certain ways, and I hope my presentation will speak to that later. If you individualize certain communities and you expect them to work in certain models and certain ways that you design, it's not going to work. This is why you find it difficult to penetrate those quote-unquote markets. So the idea is to really try to understand how they work, how they feel they can adapt to your platforms, how the expert who should inform you about what works is not necessarily that university student that got a computer science degree or whatever it is, but is actually the young unemployed person who knows the nickname of that man or the totem of the old grandfather, or who is buried there, who understands how those communities work. So for me, it's just a call to talking about how people can react against market mentalities and reject them. And I can give examples from the first world. I'm not going to, I hope I won't take too long. I remember watching something about the Blockbuster stock in the US when Netflix came in, right? And Blockbuster was on its way down. And somebody started buying that stock. As a way of reacting to Wall Street, people just started buying that stock, and the price of that stock continued to go up, right? And a lot of experts assume that at some point it's going to plateau, right? And they were giving advice to people, and all of them were wrong, because the group of people who started buying into this stock were not experts. They just wanted to react against the market, to rise against it. And the only way they stopped that stock from continuing to rise was because they simply paused the buy button. It was, for them, it was flabbergasting. And for me, that's my point, right? Expertise, this idea of what the market is, needs to start taking lessons from below rather than talking down and trying to understand people from above. I think that's my point for now.
I think we can send the microphone down this way. Let's Mario first, and then Jeremy, and then Eric, I think. Go ahead. Or Eddie.
Also, thank you from my side, and a lot of my points were already touched upon by you, but I was a bit surprised by the juxtaposition of distributed livelihoods with platforms, because I think we all know very well that platforms are actually bets and promises on they are trying to create monopolies, and that's basically what all platforms are trying to do. They are the opposite of diversification. Like when you look at, and they do that with a lot of capital. Like all these platforms are making huge losses. Like Uber, I don't know, 200 billions per year. Airbnb, I don't know, the same in the same region. So they are constantly creating losses, just betting on having a monopoly access to the market. So they are creating markets that are, by definition, that's also maybe my point, like we are talking about data, we're only talking about data, we miss data, but we have also insights into how platforms operate structurally. So also on the level of structures, we don't need data to say that platforms are by definition exclusionary. Because once they reach the monopoly, they can charge people whatever they want. And that is what is happening with when you see, and also like the distinction, like when you look at platforms, platforms don't want to be for work, for rent, for certain things. They want to combine. That's what you see with Amazon. So, and now also thinking of looking for data, I find it interesting because I felt that during your presentation, I think it's very important in the sense to capture the moment that we are in. Like, is it, because it seems like we're kind of solidifying a capital-driven state of these new markets that are called platforms, as if there's not a chance to stop that right now and start with community-based things. Or community, of course, is who can afford to create a platform. It is only the state or somebody who can make losses through for 10 years. That is the reality. So I was a bit shocked to see that you are like kind of putting it side by side with distributed livelihoods, which to me seems to be exactly the opposite. Like markets will, like these platforms will definitely decrease people's freedom, economic freedom. So.
Do you want to say it's a quick one about quickly? Yeah, sorry. It's a really quick one about embedded finance. The way I hate having to pay funeral cover and life insurance when I'm buying sofas. And I'm forced to pay this when I'm buying a car. And I'm forced to pay this when I'm buying a house. I'm forced to pay it when I open a clothing account. It's terrible. If I could stop it, I would.
Jeremy, would you like to speak now, and then we'll send it down to Eddie? Is that all right? And then down to Milford. Okay. Okay. So let's do Eddie and Milford first, I guess. Yeah.
Thank you. My question is, at every time the academics will be pointing about the bottom of the pyramid, today we have these people from the industry. Do they really want to reach those people who are at the bottom of the pyramid, or it is a narrative that we are kind of forcing on them, of which they do not want? On the insurance side, I want also to know, we always say that people are doing something everywhere they are. Then the inclusive solutions, I want to know, is there a case where you found people doing what they are doing and you try to at least capitalize on that, or pick from there, or develop your solutions from what people are doing every day? Thank you.
And then I think Milford in, and then we'll have some response. Let's do it that way. Yeah.
Okay. Interesting presentations and by Jonathan and Shanae in particular. My comment, and then I suppose a question, the idea that when Jonathan started, he talked about a quote from CGAP that we're trying to understand how the poor survive in a very difficult situation through micro-enterprise activities. I think something should have been added on to the end, in the sense that this was a world that was created by CGAP, or not necessarily CGAP, but its parent organization, the World Bank and others, that in the 1980s there was a very definite policy decision, and we can go into the politics of neoliberalism, that the global poor were going to have to survive on their own. They were going to have to survive however they could. Micro-enterprises, micro-entrepreneurship, micro-enterprise, microfinance. That policy decision was taken. So it's very rich to, in a sense, for CGAP to say, well, they're looking at how the poor survive, as if somehow this sort of situation came from space. It didn't. It was a created artifact by CGAP and by its headquarters, the World Bank and others, the IMF, US government, British government, or whatever. So that's one thing, and I do find that that quite challenging. My question is, it goes on to the second point, is that the question about going into communities and asking people, you know, how do they survive, and how can we sort of, you know, build upon your survival strategies and enhance the way that you survive. And I think there is something to that, but I think, and my question is, you know, why isn't the question also asked, and how do you think you should survive? I mean, is it that you want to be a gig worker or work in some informal micro-enterprise or some other ultra-low paid occupation? And we can try and make things better for you, possibly, but also, if that's what you're doing, we can try and make it better, a little better for you, maybe, but also we're going to try and get something out of it as well. Or should you be asking, you know, is there any way that we could transform the way you're working and surviving? And I mean, there was lots of work come out of India when they asked people, you know, what sort of job do you want? They didn't say, I want to work in a little shop or a little street table selling things. I want to work in a government office where it's nice, people treat me with dignity, it's quiet, I get a fairly decent wage, nothing spectacular. Okay, that's really important. In other words, what they're saying is they're rejecting the whole experience of the informal economy. If we start from that as the basis, then we can start to think about what policies. But also, there's a problem if you ask, or if you look at how people survive, and I do have a problem with this, because a lot of social anthropology is about how people survive and then trying to adapt and adjust it, because they did a lot of studies in the US about how a lot of the poor in urban economies survive, and one of the survival strategies was dumpster diving. Okay? This is the practice of going behind big supermarkets who regularly throw out vegetables and fruit and other food items which are past their sell-by date, and going in and digging it out and coming out. There's a whole ecosystem of survival based on that. Now, if you were to look at that, so, well, that's actually, yeah, let's build upon that. Let's maybe we can use a mobile phone so they can see when a delivery or dumping is taking place, or maybe we can give them gloves so it's a bit cleaner or something like that. And yeah, I mean, I'm sorry, that's really quite bad to say it like that, but that it would come out of this idea that this is how you survive, and maybe that's your choice and we can try and help you about it. I would say, well, no. I mean, that is one of those choices that you shouldn't have to make, and so how should you be surviving? What other strategies should be working on? So I think I just would ask then, you know, to what extent do you ask how people want to survive and how might fintech solutions change the way that people survive, rather than just adjusting to how they do survive? You know, are there better ways in future that they might to survive? Maybe those sorts of questions are not asked enough, because very often, I know in my experience interviewing, you get the answers that you can't do anything about. Well, it would be nice if government did this or government did that, and then somebody who's funding you will say, well, no, we can't have the government in this. No, this is individuals. This is the individual society. So I'm just throwing that out.
Thank you. Yes, would you like to? Yeah. And let's send the microphone around.
It's okay, I think
oh, that's right, okay.
So, oh, sorry.
Sorry. Whoever would like to go first is fine. Yeah.
Okay.
I'll make it go on to Jonathan, because I'll speak every day.
Yeah. Okay, so these are big questions, right? The notion of how much of a role platformization and platform business models will play in the livelihoods of rich people, middle-class people, poor people around the world is an open question, and it's bigger than this room. There is a ton of money, mostly northern, tied up, driven by advertising. You know, Facebook and Google are just big fancy advertisers, and they are stretching this logic into every corner of most societies on Earth. And it is absolutely appropriate for governments and people and civil society to have a say and push back and shape that. Some of the work that our little studies have done is in simply doing the inquiry of sort of how are people using platforms as presented to them. I'm not in this essay, or in much of my work, making strong assertions about what the regulatory responses will be and how countries will choose different paths to regulate and live with platforms. What I did do by introducing into a conversation over 4 days, which is about financial inclusion and the fintech discourse, this idea of platformization, is to suggest that we can no longer talk about financial inclusion without understanding the role that platformization is playing in this. And there are some good things that happen because of embedded finance and all that, and some difficult things that are happening because either the quality of the job isn't there, or maybe people didn't want to be gig workers anyway. All of those questions are true. But just to be clear, I'm not kind of coming in and saying, hey, platformization is going to solve financial inclusion, let alone be the thing that leads us to an economy that works better for more people. Platformization tends to be quite individualistic. It can't see communities very well. It treats people as users. It reduces people to being data points. The algorithm is quite cruel in a number of times about whether one can live or prosper or make a living or not. Which is why all around the world, governments are currently wrestling with how to get these things at least under control, back in the box. I think it's going to be difficult, to be honest with you. I think that nobody's got it figured out yet. And the platforms, particularly the international ones, got a real jump into the global economy over the last 10 or 20 years, relatively unchecked. So I will say this, is that, there are lots of really good critical voices, again, all over the world, talking about imagining different platform futures and imagining different relationships between the state, citizens, and new digital marketplaces that involve regulating platforms more effectively than we do now. One caution would be that it is difficult to regulate them as a lump, right? That every context is different, every industry is different. How you would regulate the freelance writing industry would be different than how you would regulate the social commerce industry or the ride-hailing industry, for example. And where regulators have tried to sort of put everybody back in the box of saying, well, no, you've got to treat everybody like an employee with all the right protections, is good for 80% and creates other losers who now can't act as the freelancers they used to, kind of thing. It's going to be really hard to get right. But that's why kind of, if we were in a telecoms conversation, or we were in a healthcare conversation, or we were in an education conversation, we should be at least looking at platformization as well. We're in a financial inclusion conversation, so we need to be understanding the role that these giant new entities are playing in restructuring what is possible and what will happen, and whether that is good or bad. There's a lot that's wrong with platforms, just to be clear. I hope that takes away the shock you were talking about. But I think you're right, that we need to be imagining different models. Not every platform is a Silicon Valley-driven thing. Wikipedia is a platform, not so bad. There are platform cooperatives where every cab driver is part of the dispatch team and makes it all work. And there's research and pilots happening on all of that. But the day-to-day reality is it's Google and Facebook and Uber and a handful of others which bubble up and seem to run the show. So let's get cracking. If you don't want that to happen, figure out what those other models are and advocate for them. And if we do that through the financial inclusion lens, maybe that's a place that this group and the people that it knows will have some impact.
Cherney?
Jonathan's questions. I think very, very challenging questions that we're still wrestling with. I think from my perspective, and maybe what I'd highlight earlier from what I was saying, is that there are different types of models. So the platforms we know well, the issues we know well, you know, your Ubers, your Airbnbs, you know, your Amazons, maybe for Africa we know Jumia. We know that all of them are loss-making. Most of them are loss-making. Many of them aren't reaching the bottom of the pyramid. But there's a lot more that's happening in the research space around different types of platforms, niche platforms, that are tackling verticals like agriculture and fisheries. We're looking at that in Indonesia. I mean, you've got Aruna, which is a marketplace that directly interacts with off-takers who buy fish from fishermen. You go and speak to the fishermen and they say, well, maybe I'm not getting higher prices, but I know at the end of the day, all of my catch is going to be caught. And I've also learned something about sustainable fishing because I'm not, you know, I'm throwing out some of the smaller fish. So there are different models and different niche ways in which they are, you know, accruing benefits to people who are, you know, have subsistence, livelihoods, and other things. And I think there's a lot of research ongoing around that because we have that, you know, juxtaposed with these very critical questions, and not all of it is going to be solved maybe from our perspectives. And so I think a big job that we have is to bring in a broader community to ask these tough questions and try to tackle them together. I think one thing that is maybe underappreciated, just from the commentary that I've heard mainly about, you know, building from the bottom up, is that in the startup ecosystem, you have local builders that are building innovations, having a good understanding of the markets they're working in. Okay, you have the guys from Silicon Valley who quickly fail, pack their bags, go back home, tails between the legs. You've got, you know, graveyard experiments like Kunya in Kenya, where they thought they could, you know, put out below $5 meals and scale very quickly. It didn't work. But there is a lot of research being done, people spending time in the field. As an early stage investor and advisor, most of the time we spend with our companies is around product market fit, understanding the user needs, not just building because tech is cool. And I think there needs to be an appreciation of how much of that is actually also happening within our broader innovation ecosystem in Africa. I mean, I recently, even on the donor side, you spoke about money, different forms of money. I spoke to Abby, who leads up the Gates Foundation's work in Nigeria. And they're doing work in Kaduna State, which is in the north, which looks very different to southwest Lagos, everything we know about Nigeria. And she just said to me, you know, they were looking at like savings products for villages. And what she learned is that, you know, people weren't putting cash under their mattresses, or, you know, even savings in a bank was unheard of. But people were buying non-perishable goods, putting it on their shelves in their kitchens, and that's how they save. So, you know, there are a lot of people that are investing in understanding the, you know, how do you build bottom up? And I think there needs to be some appreciation of that in wider disciplines. Yeah. And I touched the data points. I'm going to leave that to Jeremy. There was a big question around data and reducing societies to data points.
Yeah, I think that's a good point. So I'm going to try and tackle that slightly differently. But I mean, one of my early kind of, not early, but one of my kind of formative lessons was when I was doing a master's in international development at Bath. And one of the team was, one of the guys was from Aga Khan Foundation. And he'd been doing work in northwest kind of frontier kind of territories, and basically got in, and there was a widower who had 10 children. Actually, it was a pretty big family, and the community had been supporting her for kind of many years. And again, it's the tribal leader who's responsible for supporting her. And the Aga Khan went in and saying, this is in the early 2000s, and saying, well, maybe we should do a social grant the early days of kind of the GTP kind of types kind of space coming through, was doing a social grant. And when they engaged and tested it, they realized that that widow would be worse off from that social grant than before, because the community would now say it's not our responsibility. And so she would have been impoverished by them intervening with a more formal financial instrument to help address her lifestyle. And that's been a formative kind of lesson for me around, how do you potentially destroy the informal support mechanisms through kind of formal instruments. Secondly, when I was at Finmark Trust, we kind of had a hypothesis that as we saw formal kind of funeral insurance kind of coming through, we would see a decline in the informal. And for a couple of years, there was a bit of a decline. But interestingly, again, it stabilized and continued kind of, I think it actually picked up a bit. I'll a bit out of touch on that. So you're seeing how formal and informal will continue to run alongside each other. And that's a pretty good thing to have as well. So again, from our side, we try to say, we do the HCD research to understand the needs of those customers. And we spend a lot of our treasure spending time in people's houses, doing co-creation workshops where we're trying to really understand the needs and how they can inform it, and to ensure that we don't destroy what's happening. But at the same time, I've also been a bit more skeptical about HCD. So, and I think if you look at behavioral economics, you say, don't listen to what they say, look at what they do. So we spend a lot of our time in Rwanda, for example, doing human-centered design research around an insurance product. And there's a nice blog called Why Focus Groups Don't Work that we put out a few years ago by a co-founder. And basically what we'd heard from the clients is, this is their preferred payment mechanism. We were testing using airtime to pay or mobile money to pay. Okay, 2/3 basically said they wanted mobile money. We had an internal debate about this. I was saying this is not going to work. And unfortunately it didn't, because when we basically launched it, we found that I think only 1%, so it's about 6% of the base had more than $1 in their account. And we're talking about premiums of between 50 US cents to $1. Nobody was using mobile money for products like life insurance or other products. They were putting money in and taking it out straight away. That was one kind of tough lesson on the payment side. They also told us what messages they would like to be sent to communicate about the benefits of insurance. When we did this and tested the messages, it was the exact opposite of how they ranked it. The ones they helped craft had the least impact in terms of the communication around that. And there was a few others. I'll send you the link to the article. But basically, we spent a lot of our treasure trying to understand the needs, getting their viewpoint, co-creating products. But the reality was their hypothesis around how things should work is very different from the practice. Now, again, that's what behavioral economics kind of teaches you as well. So again, from our side, whilst we very focused around understanding their needs and community, you still need to be able to test and learn, test for product market fit kind of in that space. And I think that's one of the key lessons that we've had. You talk about don't pay money by formal mechanisms. Actually, one of the first publicized case studies of digital payment, basically digital payments, was an Economist article in the early 2000s around a client. It's about somebody paying a bribe using airtime in Congo, in DRC at the time. And that was probably the first kind of indicator that actually people want to be able to make payments digitally. There's a whole case study about the mother wanting to pay for the son and couldn't get cash to the crooked traffic cop, and so transferred airtime to that person. That's a payment. That's a digital payment, and it was basically a innovative use of an existing kind of platform. So again, I would say, the digitization certainly has its limits, but there are certain things which are being used, and you can see this by the acceleration around payments over the last decade or two. We had, I think in 2012, the GSMA looked for, 200 million active mobile money customers. We only hit that around 2021 or so. So we're a decade behind where we wanted to be, but you are seeing people using formal mechanisms. So again, I think that point around the understanding the clients, absolutely. We spend a lot of our treasure on that and learning around that. We've designed group-based mechanisms that complement burial societies or funeral parlors, which they can sign up to as a group. We also need to use the data we get from that to help continue to innovate. And at the end of the day, we need to do the test and learn, test product market fit to understand what works well for these communities.
Go ahead. Yes, and
You want?
Have you ever attended an African funeral? How many days was it? How many days was it? Exactly, and that's my point. And the point I'm just trying to make here is that African societies are complex. The products that you make are not. They're designed in very specific ways using this whole range of data that's been collected, and people are supposed to work according to what the findings are. And why I'm saying African societies are complex, right now we're talking about how people can use these platforms, right? But we're forgetting one tiny detail. For instance, of the almost 4 million Zimbabwean immigrants in South Africa, more than 3 million are clandestine migrants, and they don't have access to certain things. So the ways in which they operate are certainly going to be different from a specific, perhaps South African citizen. The same with a Mozambican, a Nigerian, or whoever. The kinds of livelihoods that inform how they survive also tend to be informed by a number of factors, right? And even amongst local South Africans themselves, perhaps depending on whether they're coming from the Limpopo province or from the Eastern Cape, their values, their cultures tend to differ. And another thing, anthropologists will tell you, historians will tell you, whenever you interview people, they can perform and not really reveal what's happening with them. You know, it's only when you establish rapport, which takes time to really understand these communities, can you extract certain things. And here's my point. When I was talking about the ivory tower, whatever methodologies that we use as academics when we go to these communities, all of it is performed, particularly because there are certain ways and certain approaches that we are designed to use in order to extract information from them. And my point was to say, let those people design those platforms for you. It's like how you were talking about M-Pesa and how Africom came in, right? It's something that came from the bottom, but they just monetized it. Rather than coming from the top and say, we think these people need these things, and therefore let's ask them what they want. And based on those answers, let's design that thing and give it to them. I have, for instance, I'll give you this example when we're talking about the poor. I have a cousin brother who is what we call a sub-book, right? An owner of the book, which means he holds the book for the entire village. He knows who stays where, who does what. And I was having a big argument with my brother, whom I thought was slacking in terms of his school. And I said to him, listen, you're going to end up like my cousin and go to stay in the village because you're not studying hard enough. And then my father looked at me and he said, but Tinashe, that guy has 8 A's at O level. He has better grades than you do. And I was shocked and I was like, but why is he in the rural areas? And he said to me, he prefers the simple life. You'll never understand him. So not everybody wants to be Elon Musk. He is probably far more actualized than Elon Musk is. Right now, Elon Musk is trying to buy Twitter for 40 billion, trying to do this and that because he still wants to earn wealth. But for some people, these platforms mean something different to what we think they mean. And in terms of how we understand those societies, I don't think we really do. And the only way we can do, I hope I'll demonstrate this in the paper, in my paper this afternoon, is by really letting them, right, show us what platforms should be designed. I think like multiple monies, you should have sort of multiple platforms. You can have a holding company, but that understands different communities differently. And you design products that are profitable for these fintechs, but at the same time are user-friendly and informed by what these societies need. So my call is not so much to say that you're trying to extract, of course you are, but the point is there are better ways of doing so, which can be informed by a partnership with these communities so that the relationship becomes mutually beneficial.
Anybody would like to speak?
Mulford for his comments about asking people what they want, what motivates them, their aspirations. We're trying to include some parts of that in the instruments and you know, the work that we're doing in Indonesia, because not everyone wants to be a gig worker or ride hailer for the rest of their life, you know. Is it a step up for them to a bigger aspiration? So yeah, those are really important questions we should be asking people.
So it is 12:35, but would you like to continue?
Very brief.
Yeah.
I mean, this is a very interesting discussion this morning, because in 2018, as I told you yesterday, we were all extremely polite to each other and diplomatic and all the rest of it. Now, to some degree, the gloves have come off. And I think this is a serious question, which I would leave you to ponder over lunch. Is there scope for this kind of discussion, or are we inhabiting two different worlds? And which may not be to the credit of the academics entirely. I mean, we think we've got the right answers, but the question remains, can we think of questions? It's funny, but all three of you, when you presented, all focused on the technicalities. It took a very long time and a lot of questioning to get you round to the issue of sort of political issues that might impact on all of this. Maybe Hannah's questions, I've forgotten what they were in detail now, but maybe you could just write them down. Can you remember them? Those are the kinds of things which may mediate between, in some way, between the two, we see now two schools of thought, two worlds of thinking. Is there any point in trying to, or we just walk away? That's my question.
All right.
Note it's lunchtime.
All right, thank you. We didn't mention the hustler, of course, but you know, the new president of Kenya valorizes his past as a hustler and all of the hustlers. So, you know, it's an idea that has taking on a cultural meaning as well, for better or worse. All right, thank you. Good afternoon, everyone. Welcome back to Persistent Barriers, New Frontiers, Fintech Futures in Africa. I'm particularly excited for the next session, Zimbabwe, Crucible for African Fintech, a country that is not well represented in the scholarship and the literature, but which seems to be an extremely dynamic space for monies of many different kinds. Our first speaker is a professor here at the University of Pretoria, Professor Tinashe Nyamunda.
All right, thank you, and afternoon to everyone. I suppose the first comment is never be too critical of other people before you speak. But yeah, it is what it is. I hope these engagements will be useful in some way. So my topic really is an exploratory research area, something that I'm still looking into, something that I'm still trying to perfect, but it's based on one, experiences, two, a little bit of fieldwork that I've started doing, and three, just me going into this place called Soshanguve, which is maybe an hour or so drive from here, and spending lots and lots of time with the communities there, just trying to get a sense of how things are going. So it's really looking at multiple monies, fintech, and undocumented migrant communities. And what I want to particularly focus on is history, opportunities, constraints. Don't be too harsh with the topic. It will eventually knock itself into shape with time. All right. So in the previous sessions, we've all been talking about mobile money and how we can make mobile money work in different places. I think maybe I might have to move closer. Can you still hear me if I move? Okay, great, because I can't read it. I want to be facing people instead of looking at that. All right, so one of the things that I just wanted to stress is the idea that the multiple monies are not new, right? And there's a lot of literature that looks at all of this, not least some of which is being produced in the Human Economy Program, but we've got work by people like Karin Palava, Jane Gaia and Palava, and numerous other scholars. And a lot of this work in West Africa has been coming out, some on East Africa, and very recently on Southern Africa as well. And what these scholars have demonstrated is that they've always been, multiple money with general purposes that has been used in pre-colonial societies, right? And they exchanged them depending on context and whatever it is that they wanted to use, right? But these monies that Africans used at different points, I really don't want to get into the history, was disrupted in some ways, interrupted in some ways, although some forms endured beyond colonialism by the introduction of colonial currencies, right? And a lot of imperial powers introduced these currency blocks. So you had something like the sterling area, the escudo area, the franc zone, and so forth. Now, some scholars from the 1950s, 60s, and 70s were actually arguing that these forms of money were archaic. And therefore, these new forms of money would lead to a currency revolution that will lead to the reduction of transaction costs, some of the points I was making a little earlier. And that would make world trade efficient and modernize international monetary systems. But in reality, colonial monies were an expression of imperial power in a gold standard context, at least until the 1930s. And colonial economies were transformed into becoming very extractive, and particularly in settler colonies, very exclusive as well. So what they were trying to do, these imperial powers, was to ensure that they imposed specific currencies which they controlled, right? In terms of controlling prices, in terms of controlling transaction, in terms of determining what was produced in the colonies, whether it was minerals, gold, whether it was the production of cotton or the production of tobacco, and there are all sorts of colonial, studies of colonial states that have looked at these things. But how did Africans adapt to this? First of all, there were all sorts of responses, either resistance, adaptation, accommodation, innovation. And even when we're talking about mobile monies today, they are the same kinds of responses that you get. Some resist them. They don't find them useful. Some adapt and repurpose them in ways that they think would be useful for them. Some accommodate them depending on what they're using those kinds of monies from. The critical point that I'm trying to make here is that the imposition of these colonial monetary systems was not altruistic. It was based on these imperial states trying to extract and develop their own economies and societies on the back of African economies. And therefore, these colonial economies were shaped in such a way that you ended up having primitive accumulation, exclusive and exploitative labor forms, financial exclusion, and so forth, right? And all of the issues that we're still talking about today, whether they're remittances, right, were all facilitated. Africans found ways of ensuring that they would send money back home, whether it was a Malawian migrant, Mozambican migrant, Zimbabwean migrant, who came to work in South African mines. But even though they were excluded, particularly from commercial banking services, accessing those commercial banks, they still had multiple ways in which they managed to either save or to either create forms of finance, right? So for example, I've given some examples here of rotating schemes, which are called ROSCAs. I should have put the full acronym there. The burial societies and other forms of, mutual aid schemes. So despite the fact that a lot of these guys were earning ultra cheap wages, they would find ways to send somebody who has died back home. They would find ways of accumulating money to allow somebody to start some sort of small business, isn't it? So they would have all of these ways, which have rarely been acknowledged by the colonial state and never really incorporated until, of course, the state came in from above and decided to say, you know what? There are people who earn very low. Let's create banking models that will accommodate them. And they came up with the concept of the post office savings bank. And you see discourses around financial inclusion with the establishment of the POSB, right? But fast forward to the post-colonial states. Now, the presentation is not going to be very organized because I'm trying to to come to the issue of how we can connect all of this history to what's happening with these discourses around fintechs, right? So I'm just going to talk about quickly post-colonial states and what have become underclass immigrant communities. Even during the colonial period, there was quite a lot of movement, right? And within this movement, there were numerous migrant communities that developed. And again, in the post-colonial state, we call it post-colonial state. I put an apostrophe there. I don't know if I should have put one there, but by post-colonial, I would rather talk about post-independent state because these, economic structures were still very colonial, although contexts tend to differ whether it's in Zimbabwe or South Africa. And in those contexts, you've got problems of rising unemployment. At this point in Zimbabwe, it's up to 90%. And a lot of the people have moved into the informal economy. So when you're talking about bringing in these mobile monies and so forth, and trying, or even raising finance through these fintech products, and you want people to, to produce a salary or whatever, that there will be a fair chance for that in the context of Zimbabwe, particularly because a lot of the people are unemployed. But even if they're unemployed, they've got multiple options of livelihoods, right? And among these options, one of them, of course, is immigration, which I'm going to zoom in on when I get to my particular case study. The other is doing all sorts of things, and I'll give you one quick example. In Zimbabwe, there's a place called Mbudzi. There's a big roundabout there. It's where buses that are headed for South Africa or the border town of Beitbridge rank, and people pick those buses and whenever they want to travel. So it's created a sort of market for people who are selling their small wares, whatever it may be. But in a context of 90% unemployment, a lot of these people may be undercapitalized, right? So what they do is they just get maybe $1, get onto a lift, wherever they're coming from, whether it's a high-density suburb of Chitungwiza, Budiro, or whatever, and they travel to this place. When they get there, they encounter a small group of young entrepreneurs who have bags of money. And they approach these young people, and these young people, what they then do is they ask them, how much do you want today? May I please have $10? So what are you going to bring to me at the end of the day? If I give you $10, I'll bring it, it will be $15. So they get this $10, they go to buy, maybe it's a crate of eggs, boil them, sell them, or it's freeze it, or whatever it is that's selling easily. At the end of the day, they've made maybe $22. They take $15, they go to pay this guy. And they take their $7. They buy a small packet of ufu, maize meal, which is called tsaona because it's so small, and tsaona means accident. They go buy cooking oil, maybe some bread to ensure that the child has something to take to school in their lunchbox with them, and whatever they've made that day is literally hand to mouth. Then they leave $1 for themselves to be able to go back. Now, what does this mean? It demonstrates these inventive strategies that these people have made for themselves, right? And for those youngsters that are selling money, literally selling money, right? They've created these big networks. I don't know if it's the right term, but they go to different places. Maybe they lend to 20, 25 people at Mbudzi. They go to another station, they lend to other people. And all of this is based purely on trust. You don't sign a contract, you don't do any of those things, but they always get their money back. If they don't, they've got mechanisms which are not always nice to talk about to ensure that they get their money back, right? So it's just demonstrating some of the ways that people have adapted to in order to survive. Now, I've just given you one example. So I've just spoken about that. This is a space which fintechs don't get to fully understand, particularly because when you're talking about financing these particular individuals, you're coming from above. And perhaps you're thinking, no, let's find a product, let's have a specific interest rate, and let's make sure we model this thing. Maybe they pay us at the end of the month or whatever it is. I don't know how it works. But how do you reach that person who doesn't have any security, right? Who doesn't have a job where you can garnish their salary? Is there a way of creating a product such that you can reach that particular individual? I have noticed when using particularly Vodacom, that when I buy a lot of airtime, if I get to a point where inconveniently I don't have any airtime and I need to make a quick call, I can easily just borrow R5 and make a call. And over time, the more you borrow, the more the amount that you borrow increases. And for each 10 Rand that you borrow, you pay back with an extra Rand on top of it, right? And given the model that, for example, M-Pesa has used, innovators can think about those things and say, okay, instead of a person borrowing $10 as airtime, can they take that $10 because they've got this particular line and utilize it as capital, and then when they recharge next time, they have to pay back with that $1. Instead of going to this particular individual, this could be a model that works for certain individuals. So this is just an example of how people can look at community sort of innovations and adapt them to these fintech sort of things. But anyway, what I really want to talk about is the experiences of immigrants to demonstrate that disconnect between discourses around fintech and what's happening in specific communities. Now, initially, for so many of the clandestine migrants, there's almost 4 million Zimbabweans in South Africa, for example, of which over 3 million of them are undocumented. And what normally happens is that when somebody dies, because I wanted to talk particularly about funerals, The first question people will ask is, did he have a funeral policy? Now, would you have a funeral policy if you're a clandestine migrant because you don't have access to some of these services? A few companies have tried to come up with products to accommodate these people. One of them is called, well, in Zimbabwe, it's called EcoSure, where you can pay $5 a month or something like that on their platform, and then they can give you up to $3,000, right? Initially, they thought this was scalable until people realized that there were problems with it. An Econet high-level worker subscribed to this particular facility. The mother died. And then he tried to get out the money, and he couldn't. He ended up writing to the newspaper and threatening Econet, saying, I would rather resign if you think I'm giving you bad press, but if I can't get it out, and I work on this platform, what more the ordinary individual? Because a lot of people would never get this money out and wouldn't say anything, because who can challenge Econet if you're just surviving day to day? So now imagine if people in Zimbabwe are unable to benefit from this, what about those in South Africa? So in South Africa, someone came up with an idea, and one of those examples is this company called Zororo Pumlani, where one is required to pay 299 Rand per month. And you can cover up to 14 people with a payout of up to 30,000 Rand. Now it uses the same kind of models that we were talking about earlier, where you have to pay a certain amount of money at the end of the month, and if that debit order goes off, you're covered. If it doesn't go off, depending on how many times you've missed the debit order, you then lose the policy, despite paying 299 Rand a month. You then get added to these WhatsApp platforms, and if you have that kind of money, you are then covered. I didn't have time to sort of work out how much this 299 Rand per month works out to by the end of the year, right? Now, there's something that I'm giving this example to just demonstrate something quickly. I was talking about this community in Soshanguve, and I came to know of it when my own uncle died, right? So I went there, being this academic from the University of Pretoria, thinking, well, my uncle was a security guard. He didn't have such a good job. I think I might have to, use my own money to really help him to go home, despite the fact that I was extremely broke. I didn't know I was going to do that. So as I was going there, I called my family and I say, listen, guys, we all know my uncle was a security guard, so he did not earn much. How are we going to help each other to ensure that his body is repatriated back home? Now, this speaks to one of the points I was talking to earlier on, that when you're looking at African communities, a person is not an island. Even before I got to discover how my uncle was covered in his community, within our own family networks, we began making plans to ensure that he was repatriated back home and buried with dignity. But anyway, I got to this place called Soshanguve, and I realized that my uncle was part of a huge community of people, all of them clandestine migrants. Now, he had established a rural home in a place called this area here, which is it's in Chiredzi. So it's surrounded by those places, Gonarejo, Chwalala, Checheche, and they spoke a mixture of Chitsonga and Shangani. I can't speak that language, but that's what made that community come together. That was the connecting point. And most of them came from Chief Mutandawe's area, right? So when I got there, the other thing that connected them was the fact that the majority of them attended this church called Zion Yetambo. Now, I was then told that we need to see what you as the family have raised before we can disclose what we can do to assist you. And I look at these people and they, you're just making small talk. Someone tells you he's a security guard. I used to work with your uncle. Someone is a domestic worker. Somebody just sells their wares on the street. And I'm thinking, how much help can they really give financially? Maybe they're talking about moral assistance. Boy, was I wrong. They had a burial society called Mupinga Burial Group. That's the name they gave it. And there was 250 of them. Now, here's how it works. If somebody dies, you pay $150, right? Which translates to about $10. And the total that they raised for my uncle's repatriation was $37,500. Now, if I'm to go back, you are paying 299 Rand per month to get a payout, once-off payout of 30,000 Rand. If you don't die, or if none of your family members die, how much money have you, I don't know if somebody can do the maths for me, how much money have you lost in just 1 year? Right? 299 Rand over a period of 12 months, and the payout you get is 30,000. It's not 6,000. So you've paid 6,000 towards this policy. If you go on into the next year, nobody dies, you've paid 12,000. You go to this model, they pay nothing as long as nobody dies, right? And like I said, there's 250 of them. I then asked out of curiosity, normally how many deaths, occur in a year? And then the sort of bishop of the church looked at me and said, "Are you wishing us dead, young men?" And I said to them, no, I'm just curious, I want to know. And he said, if 2 or 3 people die in a year, that's quite a lot. Because usually, people just go about their business. No, so what that means, when I did my mental arithmetic, is that they pay up to 450 if 3 people die, unless there's a significant catastrophe, right? Now, what is this telling us about these fintech models that we're talking about? If I'm to pay 299 and pay 6,000 a year, and I'm a security guard, I'm in that group, what did we call them this morning? The bottom of the pyramid, which means I can't afford to pay the 300 Rand. So I said to them, so how do you keep this money? They said, no, the problems that we sometimes face is that you have to rush and borrow 150 Rand from somebody, but people normally understand because there's a death, right? And I said to them, what about bank accounts? And they said, look, how would you account for the cost of those bank accounts? If we had a platform or a facility where we could say, guys, at least in the course of 6 months, if you've got 20 Rand, just pay it in, and it's secure somewhere. That money can then be useful so that I don't have to rush and borrow, and we just take it out, and we facilitate the repatriation of that person's body. What does this tell me? It tells me that the leader of the church could help facilitate a platform through which people can raise this money at whatever amount that they can put until they reach that 150 threshold. You understand what I'm saying? And it demonstrates to me that these community initiatives have always been there, but they can harness these technologies only if fintechs don't come and other business models don't come and impose certain models to say, no, at the end of the month, pay us 299, you miss the 299, you're out of, we will not cover you in the event of a death. So this Zion Yetambo, or this particular MBG, is not the only one, right? All 250 members are not part of Econet or EcoSure. They're not part of any other funeral policy that you have in the country, but they have the better cover than I do as a university lecturer, right? And this is what I was talking about when I was talking about how some of the products that we put out there tend to target individuals, and we separate them from a community setting, right? So, and there are things that bring us together. It might be family, it might be whatever it is. And here I think I just spoke a little bit ahead of my slide, but these are the issues that I've just spoken about. Now, I've just picked the example of these communal burial societies. They can work in terms of creating finance. They can work in terms of rosters, what we call rounds. If you adopt the language that we use, mikando. Mikando simply means I take some money, I throw it into a large pool, and what have you. But how can fintechs make these more effective? Maybe you can say, look, this is a source of capital for us, right? We manage your policies without charging you, but we give you a very small interest on whatever money you've got, but you utilize that money in ways that other business models and insurance companies do, however you invest them, but you ensure that you're able to pay out when people need those payouts. It's a little different from charging people significant amounts of money and expecting them to be able to make those payments every time. So it comes back to the point that I was trying to make earlier. Somebody said the bottom pyramid, was it the bottom pyramid, is unreachable. I disagree. It is. You just have to understand how they
Recording
make
in
things work.
progress.
You just have to let them lead, and you have to identify people such as this particular church leader that I was talking about earlier, right? Who knows how these things work? You identify people from those communities who know the language, right? Who know the culture, who know how to speak to people. Earlier in the morning, I mentioned that somebody can come to me and say, Sekuru, right? And Sekuru would simply mean uncle or grandfather. Or Mzaya, niece, grandchild. In English, the equivalents are very difficult to find, right? Or can call me by my nickname. Or can call me by a name that everybody in the community understands, right? It's something that your tie-wearing university graduate is not going to be able to do, so he's not going to be able to penetrate that community and understand the needs of those communities. So there's a little something that we can learn from societies such as the MBG, right? If they can bank little by little, perhaps into a mobile account, managed by selected members over time, they could raise money, some of which could be invested if there are no debts, right? You can leverage whatever is happening, whatever they've managed to put together, and help them to increase whatever they're getting, right? So instead of using just these employed brokers, utilize the leaders of these societies or members who come from those places. And I can assure you, this can be scalable. The community I'm talking about, if you're talking about 250 people in Soshanguve, you've got over 4 million immigrants from Zimbabwe alone in South Africa, right? And this can be sort of expanded to other areas, looking at South African citizens who are in more or less similar circumstances, who cannot afford certain types of products. Now, just to conclude, this is why history is important. This is why understanding that there are different money forms is important, right? It doesn't have to only be mobile money. I can have actual cash, which I can go to give to my leader, but the leader can convert it into this mobile app just for safekeeping, right? Or if I don't have the money, I can go and work at somebody's house, and that person can just say, listen, I'll pay this for you if you're able to deliver this for me to Zimbabwe. I've got these groceries that I need to take. There are all sorts of multiple forms of interactions and exchange, right? And also what's important is to understand that these systems are not designed by states or people who come and, and impose them on these communities. These are systems that have existed historically from the colonial period to date. It's a question of realizing that the platforms of the fintechs is simply to allow these transactions. And they can, be expanded to do other things, but respecting and understanding that these are ideas that are coming directly from the communities themselves, right? So this is why I'm saying infrastructures tend to not be adapted to, to these communities' needs, so they tend to be problematic, right? And just today, as I was sitting here, I got a text from our pension fund asking me to fill in these details about a funeral policy where I can add my mother and father and then, pay an extra 81 rand. Up to now, I still haven't completed filling that thing, particularly because of the nature of contracts. They do not speak to local languages. They are not adapted to the community's everyday cultures and etiquette. But does this society or burial group have the contract that we make people feel from a fintech or business perspective? They don't. They have that trust. So leverage them and make them manage those platforms, right? And what you get out of it is that scalability, because if they are successful, another society will be successful, another Mukando society, there will be all sorts of opportunities that can come out of this. And although communities repurpose technologies in certain instances, and this is something we must accept that they do repurpose them, sometimes fintech need to shift from this imperial top-down approach to really partnering with communities in these diverse human economies. Remember, I started off by demonstrating how imperial currencies were imposed for certain purposes. These people are not stupid. They completely understand that fintechs are out to make a killing, right? You've got billionaires that are created out of this. Of course, I'm hearing that a lot are making significant losses. But if you partner with these individuals, there is an opportunity to make a profit, and they also can mutually benefit from a model that you both develop, rather than a situation whereby you develop something and you try to impose it on in these communities. They are never going to take it up. So I'm going to leave it at that. Hopefully I can take questions. There are a number of issues that I left out, but I'll leave it at this. Thank you.
Thank you. I believe we can have discussion now. Isn't that correct, Professor Sharp? Is he waiting for us? No. Oh, okay, I'm sorry. So, all right, I apologize about that. There's been a change in the program. Our next speaker is Professor Simbarashe Gukurume, a professor of anthropology and sociology at Sol Plaatje University in South Africa. Thank you.
Not yet a professor. yeah, but that's fine. Yeah, thank you, Prof. Okay, afternoon, everyone. So how do I use this? Is it the same? The big one is forward and the small one back. Okay. So I think my presentation is, I think, complements what Prof has just highlighted. It also speaks to the idea of socialities and mutual support that emerges in, of course, a very global context in this case, and not necessarily within the community, but is actually building on from pre-existing mutual support that is within the spaces in which these investments emerge. So I've titled my talk, Mobile Money, Crypto Ponzi Schemes, and the Temporalities and Socialities of Waiting. And this is because of the ways in which waiting is an important part of how these investments operated. So I particularly choose to focus on what is called Triple M. And Triple M is an acronym for Mavrodi Mondial Movement. Some people also refer to it as a Mavrodi Mondial Money Box. So it's a Ponzi scheme that originated, of course, in Russia. Started in the early 1990s, and then it spread to the former Soviet countries, and then later on to other parts of the world, including in Zimbabwe and Africa more broadly. So I've decided to particularly focus on an important event that relates to this particular Ponzi scheme. That is the collapse of the Ponzi scheme in 2016. And what you can see, this is quite a loaded slide. These were headlines in Zimbabwe from different media sources that reported about the collapse of the Ponzi scheme. But between 2015 and 2016, there were already 10 Ponzi schemes that had collapsed. Many of them were locally based Ponzi schemes, which of course provided a vivid reminder of the precariousness of the Ponzi schemes and also people's vulnerability to lose money. So there are a number of interesting puzzles. I collected part of this data when I was doing my PhD around 2015, 2016. So what was puzzling for me were two issues that, in spite of this kind of evidence that people lose money in these Ponzi schemes, why do they continue investing in these Ponzi schemes? And more particularly in a Russian-based Ponzi scheme, which was a faceless scheme, which didn't have any offices, but just operated online through online metrics and algorithms and platforms, like what colleagues were talking about. So let me quickly talk about this Ponzi scheme. I think I have already highlighted that it's a pyramid Ponzi scheme that was founded by a Russian called Sergei Mavrodi, started in the 1990s and spread to the post-Soviet countries and then later on globally. In Zimbabwe, it reached the country around 2015 and also established its own local chapter. That is Triple M Global Zimbabwe. This Ponzi scheme, even on their online website, it presented itself as a mutual fund or a social financial network, which is based on crowdfunding. So people generally exchanged money, with each other when you are part of this community. So what they highlighted was, if you have got spare money that you don't want to use maybe this month or the next 2 months, you can give it to someone who wants to urgently use it. And then they connect you to the person who urgently needs the money. So you can invest it. And then after a month, you can reclaim that money back with a 30% interest. And after registering, you are also rewarded. I'll talk about that briefly. So globally, it used the Bitcoin payment system. But in Zimbabwe, it also used EcoCash mobile money. And EcoCash mobile money is the largest mobile money service in the country. I think it's one of the success stories in Africa, probably next to M-Pesa in terms of its traction and popularity. I think recently Econet Wireless, which is the telecom company that operates this mobile money service, was saying it has now reached 14.9 million subscribers. And the majority of its subscribers are also subscribing to EcoCash. And this is almost the entire population. Why? Because Zimbabwe is, from the past census, about 15 million people in the country. Of course, it's also used by outsiders. So that speaks to how popular this mobile money service is. So this Ponzi scheme operated through this mobile money service. So people could be paid, and then they do the payments either through Bitcoin or through mobile money. That is how it operated. So there were a lot of interesting discourses around this mobile money in the presentations that I attended for some of the managers, the people that would sign up as managers online, and some of the referees that would also go to lure other people to join the community because it came with a reward. And I'll talk about that shortly. So some of these discourses relates and resonate very fundamentally with some of the traditional anthropology and sociology literature that we've been talking about. Maus, gift economy, Malinowski, and other interesting discourses. And their argument was that MMM or Triple M unites the people. And I think you can see these are very small groups, of course, some of the pictures that I could get. But some of the meetings that I attended could actually be full house. venues bigger than this kind of space, where people come to listen to the managers to present on what the ideology of Triple M was about. So they foregrounded the idea that Triple M promotes financial freedom. Why? Because you are sort of removing exploitative formal financial institutions such as banks. You are literally lending to each other as a community, and then not being charged exorbitantly. And they also foregrounded the idea of how it promotes what they refer to as fair redistribution. So it can also be imagined actually as a share economy. I think there's a lot of literature around the share economy where people do share. So for me, what was particularly interesting in understanding this Ponzi scheme and how it operated was the context in which it manifested. And I think one important thing that I need to highlight is the idea of religion and spirituality within the Zimbabwean context. I think during this time, we were seeing a sort of a revolutionary popularity and growth of what we call prosperity gospel churches. And if you can look at the top picture there, at the far end, you will see a gentleman with a shirt that's written UFIC. That's a popular Zimbabwean Pentecostal church called United Family Church, which attracts thousands of people in some of their services. They actually fill up 50,000, 60,000 stadiums in some of their main events. And some of the pastors were actively encouraging church members to invest because that was one way in which you could actualize the so-called promises that, as a born-again Christian, you are entitled to health, wealth, and prosperity. And some of these Ponzi schemes were actually imagined and framed as important avenues for people to get rich and become successful. So religion and religious subjectivities and the way in which they were shaped within these specific churches also played an important role in how this Ponzi scheme gained traction and membership in Zimbabwe. And I think that would also be pretty much the same in many other countries. I was just reading an example of this same Ponzi scheme in Nigeria, that one of the dominant church, the Redeemed Church in Nigeria, the pastors were actually also actively encouraging members to invest. So it's quite popular, a popular strategy, not only in Zimbabwe, but in many other African countries. And then the other thing that I think was also important was the pre-existing culture of mutual help, which I think Prof. Nyamunda was highlighting, that within an African cosmology, this idea of sharing, this idea of mutual support and help is something that is deeply embedded in an African way of life, an African way of being, especially in some of the societies. And as a result, that also played an important role in how this Ponzi scheme gained traction in Zimbabwe. And lastly, the protracted economic crisis and the loss of faith in financial institutions. People in Zimbabwe during this time were very much, pro what is called Islamic banking, where you just keep your money under the bed. Because you take it to the bank or leave it in the bank, the government, the economy, because of hyperinflation, policy inconsistencies would just tell you that, your money is now a gold coin, like what recently happened. Or maybe your money is now RTGS, even if it was a US dollar. So people preferred to keep their money with them. So when this Ponzi scheme emerged, it actually became very attractive to many people. I've just looked around statistics just to show how popular it was. In Nigeria, it started in 2015, and within a year, it had 2.4 million subscribers. In South Africa, it had 2.1 million active members in 2016, while in Zimbabwe, it had 1.8 million members. Of course, these statistics are probably not necessarily accurate, but it speaks to how popular this Ponzi scheme was. So how did it operate? How did it work? in real life. So like I was saying, for one to be a member of this community, you had to register. And after registering, you had to offer help to other members who are in need of money. So you join. After joining, you offer the amount that you think you want to help with. It may be $100 US because it operated in US dollar. It may be 200. And this is the system. I took a picture, and I remember also joining this as a way of trying to understand how it is. You know, coming from anthropology, you always believe participant observation is very, very interesting. So I was actually one of the people that were also affected by the collapse of this Ponzi scheme. But of course, I had not put in a lot of money, but I joined, you know, trying to understand how it works. So if you are a new member, you join, and then your dashboard looks like this. You register, you offer to provide money, in this case maybe 660, that's 3.1 USD, and then you wait to be paid by the next person, or to be paid to many people, depending on who is requested how much in terms of the help that they wanted to receive. So upon registering, one would then get a 20% once-off bonus, and then a 30% monthly interest. So if you put in 100 today, if you want to get it next month, then you get it as 130 plus the 20% bonus for registering. And then when you register, you're actually given what is called a unique referral link, which is very particular to you as a member. And you can use this referral link to invite friends and family to join. And each and every person that you invite into the community would get, you would get a 10% referral bonus. So that was something that was very interesting, which explains why, you know, people would host, you know, all these meetings, invite so many people, and then assist them to register and then use their links so that they could also get the referral bonus. So if you convince a friend to register using your own link, and then that friend offers $100, you would be entitled to a $10 referral fee. If they put in $1,000, you get a $100 referral fee. So this is what happens when you enter into the dashboard. If you are providing help, this is what you do. You offer the amount of money that you want to give, and then on that extreme side, you wait to be paid. So the idea of waiting for me is fascinating, because theoretically and analytically is what got me fascinated to look at this idea of waiting. And I'll talk about that in a few minutes. So that is an example of how people are paid. That's the extreme part of the dashboard. The last slide was showing the other side, where you are providing help and you're getting help. That's the other side. So you are paid by the people that are also requesting the money. And then you can later on claim it when you feel like you need to use it. So waiting is an important part of how this Ponzi scheme operated, because you join, and then after joining, you offer help, and then you wait to be paid, right? In most cases, people would wait for some time. If they get paid, and even if the money accrues the 30% interest at the end of the month, they'll still wait for it to accumulate even more money, so that they could get as much as possible. So some of them would simply concentrate on getting many colleagues to register and then get the 10% bonus. When they get that 10% bonus, they trade it to ensure that it gets the other 30%. So it was very fascinating, this idea of waiting, which I would try to highlight in a few minutes. So people would also wait to cash in, to be paid. they would wait also to cash out their money. So theoretically, I find Jane Gaia's work, and more particularly the idea of punctuated time, to be very interesting in understanding how this Ponzi scheme operated, and also in looking at issues of temporalities and socialities that are part of this scheme that I'm looking at here. So I'm particularly interested, not necessarily in the metrics or the algorithms of this Ponzi scheme, but I'm very much interested in the process of waiting. That is waiting to be paid, waiting to cash out your money, and how this waiting configure and reconfigure social relations among the participants, the managers, the referees, and other members of the community. I'm particularly also interested in the temporalities of the Ponzi scheme investments and the socialities that they engender. But I ask an interesting question with regards to, when this Ponzi scheme collapses, what else collapses, right? In terms of socialities, in terms of social relations. What else is lost apart from the material money, or even the symbolic money or the electronic money that is lost in this process? That is something that I'm particularly interested in. So when it comes to waiting, I think I can give two stories of two participants who I found to be interesting in this Ponzi scheme. One of them is a gentleman called Andrew. Andrew was a very loyal Pentecostal member of a popular Pentecostal church in Zimbabwe, which believed and propagated prosperity gospel. He had invested part of his money that he wanted to use for his wedding. So he had planned a wedding, and a friend in church encouraged him that, you can put this money, when you put this money in 2-3 months, all the other money that you wanted for the wedding would be ready. So he was convinced and then put in the money. Unfortunately, just before the wedding, I think it was close to a month before the wedding, that's when the Ponzi scheme collapsed. And when it collapsed, it also collapsed with his wedding. It also collapsed with his marriage. Because when he invested the money, he had not informed the prospective wife that this is what I'm doing. So the wife was preparing for the wedding, but Andrew knew that it was going to be extremely difficult for this wedding to go on. And that, for me, was very fascinating. The other participant, I call Amos, was a student at the country's biggest university, the University of Zimbabwe. And Amos had, for 2 semesters, used his tuition to invest in this Ponzi scheme. Initially, benefited significantly from the investments and even managed to pay the tuition fee for that semester, and remained with some more money for upkeep. But he started living a very luxurious life on campus, buying all these gadgets, modern gadgets for his room. And when the money for the other semester came, he again put it through the investment. And unfortunately, the investment collapsed before he paid his semester's tuition. And that also came with a lot of things collapsing, from being in trouble and, with the parents, the university, and other things. So for me, the socialities embedded in this Ponzi scheme is what fascinated me. And I found the work of Jane Gaia to be very interesting, especially, like I said, the concept of punctuated time within these Ponzi schemes and how it shaped and mediated Ponzi scheme investments. So Jane Gaia argues that punctuated time relates to the gap between the distant future and the present. And punctuated time also involves waiting for a specific future event. And in this case, waiting to be paid, waiting to cash out your money, and other forms of waiting that were a key part of this particular Ponzi scheme. So borrowing from Gaia, I assert that the investors wait for a distant event in the near future, for instance, seems to be evacuated. I think the evacuation of the immediate future is an important and interesting part of Jen Gaia's idea. So apart from one having to wait, there are certain things that fill in that space of waiting, like what Gaia asks, for instance, what becomes near when the near fades from collective consciousness. And I argue, based on the findings in this work, that near is filled with socialities of uncertainty, precariousness, and perpetual waiting. What is interesting is that when this Ponzi scheme, I'm almost done, when this Ponzi scheme collapsed and people received the news that their accounts have been frozen, a lot of people rushed to click the get help to try to cash out their money. Some of them didn't believe that it had collapsed. They just felt, this was just, people trying to sabotage the platform. So a lot of people rushed to get help. So how this Ponzi operated was, it is just like any other Ponzi schemes that you are paid on the basis of how many other people are willing to offer help. So there were a lot of people that were now demanding help, and very little, if any, who were offering help. So the system literally collapsed. But these people that had asked for help through the Get Help system were still waiting to be paid. They were still waiting that at one point, probably we are going to get assisted. So this was very interesting for me. And then the argument that I try to make, of course, very tentatively for now, is that Ponzi schemes such as Triple M should be viewed as a space through which investors sought to reconfigure the future and foreshorten the distant future through these investments in Ponzi schemes. But like I emphasized as a way of concluding, that within the Zimbabwean economy, because of the protracted economic crisis, limited employment and livelihood opportunities, as well as the context, which was also marked by religiosity, prosperity, there was an inherent pressure for people to succeed in a very constraining economy, where people have access to so-called modern gadgets, but a very limited capacity for them to access these gadgets. So the context matters, especially in the dynamics and the form that these Ponzi schemes took within the Zimbabwean context. And spiritual subjectivities also played a significant role in how this particular Ponzi scheme gained traction in Zimbabwe. So thank you very much for listening to me.
Let me just check the time really quickly. It's tea time, wonderful. So we are going to have tea and then come back here at 3:30 sharp to discuss these fascinating papers. right, welcome back to our afternoon session. We'd like to announce a small change in the program. One of our speakers was unable to make it, so if you turn to the other side of your program, we'd like to announce that the Human Economy program is very happy to have doctoral candidate Edson Chiwenga speak next. And that means that Edson's slot from tomorrow at 10 will be, we'll do a little bit of shuffling around, and then tomorrow on Wednesday we'll have a little bit of extra time off for perhaps a walk or any other activities. We will finalize the changes to tomorrow's program in a minute. And so let me again announce Edson Chiwenga, doctoral candidate here at the Human Economy Research Program at the University of Pretoria.
Thank you. Yeah, I'm a doctoral student here at the Human Economy. My research focuses on how people are using mobile money in everyday life in Zimbabwe. In 2020, like many other pro-fintech organizations, FSD produced a report talking about mobile money in Zimbabwe as a way which has saved Zimbabwe during a period of cash problems. According to the report, between 2016 and 2018, the total value of mobile money transactions increased by 628% in Zimbabwe, which is very fantastic. Mobile money was a lifeline for the ordinary people in Zimbabwe, and it had gone a long way in replacing cash. According to FSD, this technology can help people in Zimbabwe to manage their money, to do with risk, and to make the much needed investment. In my research, I went to Zimbabwe to interact with people in their everyday life. I did an ethnographic study, and I interacted with people to understand how are they really experiencing mobile money in their everyday life. And my findings in this research, I saw that the way in which people are using mobile money in Zimbabwe's multi-currency system is complex and cannot be explained by just celebrating the 628%. It is something which is far beyond that 628%. According to FSD, they say there are verticals in the use of mobile money in Zimbabwe. These verticals, I found that in Zimbabwe there are a lot of issues surrounding mobile money. I found that there is an informal hierarchization of money, convertibility issues, considering that we said there are cash shortages, and limited purposes are being ascribed to different forms of money in Zimbabwe. So the thing is, for us to understand this whole thing, we should have an appreciation of the history of Zimbabwe's monetary landscape in the post-2000. I will not take us to very far. I will at least try to take us just in the post-2000. There is one thing that we all know Zimbabwe for, the hyperinflation, where we had $100 billion or $100 billion a single note. You remember that Zimbabwean story. I think everyone knows it, right? Then after that hyperinflation, many people say that the hyperinflation was a result of the land reform and other many things. Then there was a government of national unity. The government of national unity, the ZANU-PF government brought in MDC, and they were together in power. The most important thing that they did was to bring a multi-currency system. This multi-currency system was mainly to counter the inflation problem, that hyperinflation thing. And then this multi-currency system, they adopted a basket of currencies, the USDs, Rand, and most of everything which was salaries, for example, they were denominated in USDs. And ATMs in Zimbabwe started to dispense USDs.
So it is during this period of time when mobile money was adopted in Zimbabwe. People were able to cash in, cash out, and it is a form of money which was really celebrated in this situation. Then we had a post-GNU period where cash shortages began. The government introduced bond coins, the government introduced the bond notes. Then we have this current dispensation, the new dispensation. There was a coup in Zimbabwe, then we have a new dispensation. It also came with its changes in the monetary landscape. It brought the RTGS. Remember, I told you that salaries were denominated in USDs. Then later, this new dispensation said your balances which are in USDs are now in RTGS. It was something which was just made overnight. You have 5,000 in your account. Then tomorrow morning, it's no longer 5,000 USD. It's now 5,000 RTGS. And then the next move, they said, your money which was in RTGS is now in Zimbabwean dollars. Those were the changes which were happening. So what you just see is a change on the denomination of your money. It's now RTGS, it's now Zimbabwean dollar. This was also happening to those who had mobile money accounts. Let me take you through how mobile money worked during the government of national unity. During the GNU period, mobile money worked very well in Zimbabwe. You could cash in, cash out, send money to your mother in the rural. She could just cash out, buy her groceries or make payment. There were no cash shortages. Mobile money was really working. That is one thing that we should celebrate. It had many features. Like you could save, pay, cash in, cash out. There was EcoSave, where if you save your money in your EcoSave account, it could even have some interest. So you can save $100 at the end of the month. It can be $106, for example, depending on the interest rate. So, and you could easily cash out that money. Then in the post-GNU period, mobile money, is it still really an alternative to cash, like FSD says, like other pro-fintechs say? They say, let us adopt mobile money because it is equally convincing that it can be a complete alternative to cash. But in the post-GNU period, it is at this time when the Zimbabwean government, cash shortages started. Then when cash shortages started, people started to struggle to cash out. Then when people started to struggle to cash out, that simply meant that mobile money had lost value compared to cash, all right? Then the government tried to intervene by introducing the bond coins. These bond coins, they were said they are change for the USDs. We only have a $1 note. This is the government. We have $1 notes, but we do not have 50 cents. So what we want to do here is we want to bring convenience to you. So we are creating these coins for your convenience. You get it? And then this resulted in a situation where there was a hierarchy of money with these coins, and later in 2016, they then introduced the notes, they justified it. When they introduced these monies, mobile money continued to lose value. There was a hierarchy in which the USD was on the top. These coins and these notes, they were also in short supply so that they will maintain some value. So there was a hierarchy where there is USD on the top, the bond notes, then we had the bond coins, then we had mobile or other digital forms of money. So with these other digital forms of money, it is in this environment where FSD celebrated that in 2016 to 2018, mobile money transactions in Zimbabwe, they rose by 628%. And then how are people really experiencing mobile money in that introduction? So from this overview, we can see that the government's efforts at every time. We can take, for example, in 2018, they said your balances which were in USDs, they are now in RTGS. In 2019, they reintroduced the Zimbabwean dollars. In 2020, in 2019, they banned cashing in and cashing out of mobile money. And then all these things were happening. Mobile money was also a victim in this process. So the successive government efforts and actions in the post-GNU intensified the devaluation of mobile money. So it is this form of money which we are celebrating, the increase in use. So is it really benefiting Zimbabweans? That is the question. Mobile money in the GNU, okay. Mobile money in Zimbabwe now, which is the period in which I am conducting data collection. Zimbabwe economy is highly informal. And also, people buy almost everything that they want from this informal economy. Buying everything in the informal economy, it is in that informal economy where there are these convertibility issues. The informal economy is demanding a certain form of money, while mobile money has limited purposes in this sense, because it is difficult to convert this form of money to cash. Then this informal economy is in Zimbabwe, it depends with imports from South Africa. So for people to get goods from South Africa, they need foreign currency. Then the process of converting mobile money to foreign currency is a very long process which requires one to convert mobile money to cash, then mobile money, you can convert it to USD, then you convert it to the rand. Then that is the situation in which mobile money is operating in Zimbabwe. When paying with mobile money in the informal economy, for example, therefore, in Zimbabwe, when paying with mobile money, you are required to pay a premium. It is in this economy where for you to use mobile money, the seller will then ask you to pay a bit more to allow him to convert that form of money to a form of money which will be useful in the economies that you would then use the money that, for him to buy or to restock, they need South African money. And this mobile money is something which is below the bottom, below the pyramid. So the processes in converting mobile money are really hard for Zimbabweans. The official exchange rate also is another thing, which the bank in Zimbabwe has its official exchange rate. They say mobile money, to exchange it to the USD, for example, it is at $500. Then the real exchange rate is found in the streets. Then people in the streets do not respect this rate, which is the official exchange rate, which is issued by the state. So people, for you to convert your money in the street, you will be operating with a rate which is far higher than the rate which you are using in the formal system. So to celebrate the use of mobile money in Zimbabwe is another thing. The poor people, they buy in the informal economy where the required form of money is not mobile money. The required form of money in the informal economy is USDs. So the poor, they struggle to at least get the form of money which is required to buy. They have received their earnings in mobile money from different transactions, mainly because the poor, when this discourse of financial inclusion came, the poor people opened mobile money accounts. Then after opening these mobile money accounts, they then, these are the accounts which they have. Then when you are paying them, you transact into that mobile money account. Then it is this form of money which is not needed in the economy where this poor person is supposed to buy. And then this form of money is not needed in that economy where this person has to buy. Then for him to buy, he either have to convert that money with the money changer or to pay a transaction, to pay a premium. For example, at tax shops where most people buy, you go to a tax shop with your mobile money. Then you find things there, their prices are pegged in USD. Then you have to agree with the tax shop owner the amount of money which he accepts for the USD. The tuck shop owner has his exchange rate. We said the state has an official exchange rate, right? And then the tuck shop owner, because he or she will go through his own struggle to convert mobile money to cash, will then ask you to pay using his own rate. So, for example, when you arrive at a tuck shop, you then ask, how much is this product? It may be $2. Then the official exchange rate may be $500, for example. Then you negotiate with the tuck shop. Then I want to pay with equal cash. Then he said, my rate is $700. Then you do not have an option. It is this form of money that you have, and you really want this product, and there is no other way. This is then the form of money which we are celebrating its adoption in Zimbabwe at 628%. But how are poor people really using this form of money in the informal economy? Then why are people not buying in the formal economy is the other thing. Because in the formal economy, it's true, they use the official exchange rate. But this formal economy is small, and most Zimbabweans buy things in the informal economy because things are cheaper in the informal economy as compared to the formal economy. Why? People in the informal economy, they just smuggle things into Zimbabwe. People in the informal economy, they just smuggle things into Zimbabwe. People in the formal economy, they bring their goods through a normal channel. They pay jute, they pay production costs to transport these things from here to Zimbabwe. Then this one is just smuggled, communicated with the truck driver. Then the thing is, things in the informal economy will inherently be cheaper as compared to the formal economy. Then poor people in the market where they can buy, which is where there are better prices, it is in this market where this form of money, which is mobile money, is not wanted, is not desired. It is something which is at the lower, at the lowest in the bottom. Then it is this form of money which is being used by people in everyday life in Zimbabwe. Then the new dispensation, the government, I showed you the stages of governments in Zimbabwe. Then the new dispensation, when they go to power, then so that we are not having any taxes, we do not have a formal economy. So how can we get taxes? The government wanted taxes. So they said, let us make all mobile money transactions to pay 2% tax. It is these poor people that we are talking about that we have given this technology, which is really working according to Fintech. Then the state is saying that we want 2% tax, then there's a transaction cost. Then it is these poor people who are then paying through the nose using, when they are using mobile money in their transactions. These taxes are automatic. When you are just paying, they just take their 2% tax. That you can find someone struggling on the queue. He had, for example, he wanted a product which was going for $600, for example. Then he or she has $630 in his mobile money account. Then there is that transaction cost which is needed. There's a tax which is needed. Then that person who may fail to pay because item number one, the transaction cost has to be paid, then the tax. So these people, this is how they are experiencing mobile money, a form of money which is not wanted in Zimbabwe. Then cashing out in an environment where cashing in was banned. The other intervention on mobile money transactions, when Gukurume and Mahia conducted their research in 2015-2016, they found that people were obliged to pay a bit more when they are cashing out because there are cash shortages. So for you to cash out at least $10, you can cash out $15, for example. Then the agent will give you $10. Then the state intervened and said, no, these agents are profiteering. They are taking money from people. And then this is the other thing that they did. No more cashing in and out. You only have to use that money in your mobile money account. So cashing in and out, it didn't actually stopped when the state said no more cashing in and out. People are struggling with their forms of money, and they are doing different things to try and cash out. We can take, for example, there are money changers in the street, which is a common phenomenon in Zimbabwe. If you walk in the Zimbabwean streets, there are people, the informal money changers, because cashing in and out was being done by agents, right, which is normal with mobile money. Then these agents were banned, no more cashing in and out. So now cashing in and out is now being done in the streets, right? So with these informal money changers. So the technology which people were given, the mobile money technology, they then improvised. They used the send cash. I send money to the money changer, then the money changer will then give you cash or USD, depending on the form of money that you want. For example, if I want $100, I can, the money changer can say, my rate is, okay, if you want $100, send me $170, for example, if we are using it in USD terms. But there is a whole lot of things with mobile money is denominated in the Zimbabwean dollars, and the informal market is demanding USD because where they get goods here in South Africa, it is easier to convert USD to Rand as compared to converting mobile, then the process will be too long. So these guys are people in everyday life, they are forced to then exchange this limited purpose form of money, mobile money, which is now limited in many spaces because it can no longer do what different other forms of money can do. It is now limited. If it's in your phone, you cannot cash it out. Then to cash it out, you are now strategizing. As you are strategizing to cash it out, you change with money changers and also trying to protect themselves from the market. People are also using social relations, for example, to cash out. For example, I know that this person has USDs or has received a remittance of USDs. Then I ask that person, or that person can ask me if he or she knows that I have mobile money. I want to go and buy something in the formal economy where mobile money works better. If he or she wants to go and buy something in the formal economy, I will then go and pay for that person using my mobile money account. Then he gives me the US dollar, right? Then the other thing, the state, at every time, it tries to counter what people are doing. It realized that people are sending each other money. So they started to come up with transaction limits, like you can send this amount of money per day, or you can send this amount of money per month. Then it is it is these technologies which are being given to people. Then people use this, the merchant lines, they make payment. The money changers, they go to Econet, they apply for merchant lines. Then they say, for example, the merchant lines, these are payment, which are used to make a payment, right? So if one wants to make a payment, they use these merchant lines. So the money changers, they go in with a certain business name like fish restaurant, for example. Then they will be in the streets with those merchant lines, but what they are selling is they are selling money. For example, they understand that people have mobile money, but they need USDs, right? These people who need USDs will then come to the money changer, where is the merchant line. They do a transaction, make a payment. And then according to the state and according to FSD, the payments which are being made in mobile have risen. But are these payments really payments for goods and services, or it is how people have adapted mobile money in the Zimbabwean economy? This is how people are responding to the constraints which they are faced with, and this is how people are struggling in their everyday life with mobile money in Zimbabwe. So what I found that is that not all payments which are recorded as payments by the RBZ, by FSD, are payments of goods and services. Some of the payments which are being made are money exchange payments, where people will be trying to get rid of mobile money and get a form of money which can be used for a certain purpose that the person wants to use it for. As I said, mobile money in the informal economy, if you go to a seller, they can say, no, I'm not accepting mobile money, or if you are paying with mobile money, you have to pay this amount. So people in their everyday life, they then juggle it every time. which is, what is it that I can do? Should I go and buy the USD which he or she wants? Then I told you that the tax shopkeeper says my rate is. Then the money changer also has his rate. This person who I said my family member who has received a remittance also has his rate. The state has its rate, right? So everyone has his or her rate. So you then juggle, where am I getting a better deal for mobile money? This is how mobile money is being used in Zimbabwe. So in a conclusion, is mobile money really benefiting the poor in Zimbabwe, considering how it is being used in everyday life? This description that I've given is how people are using mobile money in their everyday life. Then from my observation is that I'm seeing like poor people are losing at every turn. After receiving mobile money, you need, it works better in the formal economy, of which things which are in the formal economy, you can't afford them. Then when you want to use it in the informal economy, you are paying more than, then for you to convert it to the best form of money, you struggle, you have to negotiate and see how best can I really get the best value with this form of money. So there is everyday strategizing which is happening with mobile money, which shows that money is not just a technology. There is a whole lot of things that we have to understand on money. It is a political thing, it is a social thing, it is about social relations and a whole lot of things. So mobile money, for me, it was powerful when it was convertible to cash. That is one other thing. It really worked during the government of national unity when it was easy to cash out. Then when cashing in and cashing out and cash shortages started, mobile money became something else. Thank you.
Thank you so much for these fascinating papers. So now we're going to have some discussion. I think we have some really important themes that maybe we haven't even had a chance to delve into yet at the conference. Trust, informality, of course, the state and governance and its relationship to money. So I think we can move the microphone around.
Presentations. Really fascinating. I really loved the ethnography in this last one about how people are kind of creatively circumnavigating the limits on mobile money and in their situation. So there's a tendency in development studies as well as anthropology sometimes to kind of romanticize the poor and to kind of romanticize the coping strategies, which your presentation just very nicely described. But we also know from the economic anthropology literature that scarcity creates competition and it creates violence even sometimes. So I'm wondering if there's this kind of assumption that many of us are taking in our papers about these kind of creative coping mechanisms by the poor, the way that the poor have mutual aid systems in place, if we're taking that for granted too much. So, for example, Tinashe, you described the funeral system in which church leaders were able to raise money to support a funeral. And then you asked the question, well, how could Fintech come in and, collaborate with that and then, I think as you said, maximize that in a better way. So kind of looking at these solutions that are already on the ground. But then in Simbarashe's presentation, you see these very same church leaders actually taking advantage of their congregations, right? They're using this prosperity gospel. They're going out to their congregations and getting them to buy into this Ponzi scheme, which is bankrupting everybody. And they're using Fintech, to organize that. So I wonder, how do we avoid not only these kind of, how do we think about not only these creative ways that people have been able to circumnavigate the limitations of the financial structures that they live within, but how do people also kind of game the system often in negative ways for the community, and what are the kind of interventions that we should be thinking about in those cases?
My question or comment is to Prof. Tinashe. I appreciate the argument that we should restore agency to the people and privilege the people when you're thinking about these innovations and cultural sensitivities and whatnot. You could make the argument plausibly that most of the solutions that come from the bottom up, if you think about the Roscas that you mentioned, or cooperatives, or even M-Pesa, the ones that come from the bottom up, have been able to endure for a long time. That argument could be made. But my question or comment really is, people might know what they want, but do they necessarily know best? Yeah. And perhaps I'll want to ask Professor Sharp to make a comment as well. Do they really know best? Because if for example, is it important, because the industry insiders would tell you that they did some market surveillance and they were able to come up with a need that's in the market, and that's how they designed their product around that. They'll obviously tell you that, right? And in fact, I think some of these solutions that we see, for example, if you think about Mukuru, for example, which addresses the very people you talked about, the undocumented migrants. I suppose there was a need for undocumented migrants to send remittances back home. They were doing it through truck drivers and the other means, relatives and whatnot. So was it a problem for an innovator coming from the ivory tower to come and say, I see there's this need and I'm coming up with this solution, so transfer money through Mukuru, because it's addressing some need. So is it a problem for, does it matter where these innovations come from really? And so that's kind of my question or comment. People might know their circumstances, but perhaps an innovator could come in there and create value, as they like to say, and profit off of that. I'm still taken back to the M-Pesa example. It came from the people, right? But Safaricom kind of appropriated it, and it's now their biggest revenue earner, by the way. So it surpassed data and voice calls and all the other revenue streams. So someone will just come, the solution might come from the people, but somebody will just come in and formalize it and put it out there, and everybody will probably subscribe. So does it really matter if where the innovation comes from? Because we are all part of the human economy, and that's where probably I'll want to ask Professor Sharp to help me understand. Yeah.
I think what comes across in the two papers, the first two papers, on the one hand you had communities where they responded to their need, developed their own ideas, and that was seen as something really positive. There were positive results, and the conclusion drawn was that we should always look to local people to come up with the solutions to their own problem. Then the paper after that basically said, well, hang on a minute, hang on a second. People didn't actually know what they were doing because they were investing in what were quite transparently Ponzi schemes. So there's a real contradiction between the two papers. I mean, I think it's a bit of both. I mean, I think, as our colleague here was saying about M-Pesa, the idea was bubbling in the communities for this, that there was a need. Well, initially it was a need for microcredit, or they recognized a need for microcredit, but then when they recognized also that the local people were actually saying, well, it's not microcredit so much, we want money transfer, and the technology was very nimbly changed into something else, which is a good example of listening to the community and then building upon what you hear, using maybe your knowledge of technology to accelerate, to put their idea into hyperdrive. Sadly, in the M-Pesa case, it went massively into hyperdrive, and as you mentioned, it was basically taken off them. It could have evolved into something very, very popular, very collective, but didn't. I mean, it was taken off. One thing I would say on that, I mean, I've had some communications with people about M-Pesa and about what are the alternatives to, in a sense, Vodafone owning it. One of the issues I studied the former Yugoslavia, and they used to have, I mean, this is before Fintech, but they used to have a money payment system through the post office. And you just went in, if you wanted to pay for something, you wrote out your little bill. If you needed to buy something, they would give you a little a bill and a number, and you'd go to the post office and pay for it. And it was very easily done. It cut out too much corruption from the informal sector, because you needed that receipt to be able to say, well, I have a guarantee. I did buy that. I want my 1 year's guarantee. The state could also monitor what was going on and who was buying and selling. And it seemed to work very well. Now, when the transition took place, this, of course, was seen as the big state. We must get rid of anything. And they basically handed over the money payment function to, you've guessed it, the Western banks. And so we now pay for every bill that we make up to 50 euro cents, in some cases up to €1 for every bill we pay, because we have no alternative but to go through the bank. We used to be able to go to the post office, but because they're fattening it up to go private, they have started to charge. And so if you want to pay your slew of bills that come in, even if you want to pay it through your mobile phone, which we do now, you still get charged. So you pay all your bills, and then instantly after you've paid them, you get this whole list of charges for your payment. And you know, to the extent that my wife and I have opened up another account so we can pay with another bank, which charges much less than this one, but sooner or later they'll start putting it up. So what I'm saying at the end of this is that there was a way of doing it which was quite unproblematic, unfussy. It was a public service. I don't know how much it cost. I don't think it cost very much. And if it did cost very much in the paper times, it probably wouldn't cost very much now in fintech times. But instead now you have 9 or 10 banks running their own fintech operation, and each charging you 50 cents to make a payment. And sometimes you have 20 bills a month for different payments. So I'm just saying, this idea of, I think you're right, you know, the idea was taken out. The alternative direction would have been to say, wow, this could be a real earner. I mean, it is an earner for the Kenyan government, because 30% of Safaricom is owned by the government, and it's a big revenue driver. But that's not to say that it couldn't have become a public service in its entirety. You know, there's nothing really to stop it to do that. So I'm just saying that there are various means of looking at fintech and using local knowledge and knowledge from innovations and knowledge brought in from elsewhere to devise alternative pathways, other than the ones, in a sense, we're being forced down because at the moment it's being driven by, by an investor mentality. And so there are possibilities to do things in a different way if we sort of free our imagination to think of, well, how might this actually, it's a great innovation, how might this best benefit the community? And let's start from that. Let's start raising the money, or let's start putting it together. So that's just an idea.
Good afternoon, everyone. My name is Kevin Mutiso. I came in a bit late, but I've thoroughly enjoyed the session so far. I wanted to make a comment on the presentation Professor Tinashe made. I thought the explanation and the use case for the funeral or burial service was quite fascinating. And when I saw the juxtaposition with the commercial product and the fact that it offered, you paid more but got less, was also quite insightful. And then, so as my questions were, is regulation part of the problem? And why do I ask this? When you're designing fintech products, a lot of times you need to get approved by a regulator. And sometimes the regulator has certain requirements that affect how you price and how you roll out the product. And so, for example, an insurance product or insurance company must have a minimum capital requirement. Whereas the funeral service that was sort of bottom up, as Eric has described, does not have to be regulated. So they have a different set of parameters. They must they're sort of solving for themselves without having to pass through a regulator who's going to question them on things that may not even be necessary to that product. The second question is a question to the room. So some of these bottom-up ideas obviously are very functional and very useful to the communities which they serve. My question is, are they scalable? Yeah.
I think you indicated that communities have been relying on the informal systems or traditional based kind of financial services to support all the challenges that they've been having. But I think we need to also recognize that even some of the forms of informal credit systems that they've been having, they have shortcomings, like the ROSCAs and the rest. And then in that particular case, probably does the fintech come in a way to try and sort out some of the issues that are there. And then maybe a follow-up on Mutiso. I think at some point, the services that maybe the informal sector offers, the ROSCAs and the rest, maybe it's not able to accommodate all the needs of a community. Like, for example, take an example of a small SME business. Maybe the informal credits that are available might not necessarily be able to provide all the necessary capital for that business to upscale. And there is also the other issue of, like, for example, take an example in Harare, where with the same informal banking system, you meet people who are assembling in Harare come from different backgrounds. Therefore, there is also likely to have mistrust in also the welfare systems that they have. And maybe probably when you have a fintech that comes and offers that particular product, it helps sort the services. Yeah.
Yeah, I think I've enjoyed all the presentations today. I'm not from an anthropology background, so it's been really great. Simbarashe, maybe just some useful comments, I think, for the three presenters. I really enjoyed your paper. I mean, Ponzi schemes are not new, and I don't stand here to defend blockchain in any way. I think with all the sort of theories that you were bringing into it, one was missing for me, and that was around the network effects of multi-sided matching platforms. So in effect, you're talking about a peer-to-peer lending model, right? There are two sides to that network. And so how does technology and how do network effects make that go more viral than an analog Ponzi scheme? There are other platforms, maybe chat messaging platforms, Instagram, that religious leaders and others can use to influence at scale. And some of those factors may fit into what you're discussing, or maybe some of the sort of driving factors of how it became so big in Zim. And then I think for the last presenter, it was the postgrad student, yeah. Really good, I think, findings from the ethnographic research. I think for me, it's kind of just missing a framework to bring it all together. So you were talking a lot about like the use cases of money, like what are people's actual needs with respect to the different types of money they could be using, right? And there's a lot about needs and usage frameworks in the financial, and also you're kind of talking about an event analysis, which was strongly based on the abolition of Kiko networks. That's essential for mobile money. So if you're doing a sort of pre-event versus post-event experience of users, what were the other factors at play? And is that issue of convertibility specific to mobile money or other means of money as well? Yeah. And then I think just for Tinashe, mainly what I was missing was just a sort of systematic review on the evidence. So I think it's really useful to have case studies of particular burial societies, but I don't think this is probably new in the literature. So what else could we learn in Zimbabwe? It's a topic that's been deeply covered for, I think, 2 decades in South Africa. Jeremy Leach, who used to work for Finmoc Trust, they did a big investment in research around burial societies and formal groupings, even abuses of funeral parlors. And are there things to learn there, or any similarities, or things that are coming out of Zimbabwe that we can learn too? Because for me, the funeral bits and the mechanisms that come out of financing that, for me, there wasn't a clear connection between that and necessarily what fintech is all about. So just finding that connections in your paper, I think there's something more systematic that can be produced there. Yeah.
Okay, Simbarashe, just a simple one. Who owes the investor the duty of care in that particular system? I'll just need a clarification on that from your observation.
Can you come again?
Who owes the investors who have put the money in the system the duty of care?
Just to echo everyone, I think it was 3 really rich papers. And a lot of very struck by the contradictions between the first 2 papers, Simba and Tinashe, and just wanted to ask you to maybe both reflect on your own reflections on those 2 papers being put together. And I know very little about this, but it was just really a footnote for Tinashe is, I read somewhere in the last year or so that the ZCC Church, which has in South Africa, I think something like 12 million members. I think that my sense is, I don't know the literature around this, I'm sure lots has been written, but there was a new scheme being developed between Time Bank, which is one of the new low-cost banks in South Africa, in which Patrice Motsepe is a key player. And I don't know the details of previous schemes, but I think the ZCC Church is maybe something interesting to think of. It's working at a completely different scale. I imagine it is trying to leverage the numbers of people it has as members in ways that serve them, but I'm sure there's a lot to be said in perhaps putting your very much smaller case study into conversation with work that I'm sure has been done on the ZCC Church more broadly. And then I just had 2 quick questions for Edson, and just to say, I just thought it was really wonderful to see how you just showed with so much detail how we think often mobile money, as it's talked about, as being kind of frictionless, and just the number of people involved in allowing people trying to use mobile money in the best ways they can. But you ended with a point right at the end where you said the poor seem to be losing at every turn, and that seems to be true in one sense, but I also wondered if there's a way in which exactly how it's working is also serving a much larger number of people. So the kind of convertibility issues also mean more and more people can take a cut or a slice of those transactions. And there's another way in which you could see that same problem, also a way in which more people, so you can see it in a redistributive sense, and was interested in your comment on that. And then the last quick question was just around, I guess it was similar to the question here around the kind of colliding, are there various factors colliding into the limited purposeness of mobile money or the increasing challenges around it? So I wasn't sure on the timeline, but did this new 2% tax on transactions, enhance some of these other issues and the way in which people, in the Zimbabwean context you're describing, come to see mobile money as being less useful, at least in certain instances? But really rich, thanks.
Hello. Thank you very much for the presentations. I just had, so I feel like one topic that maybe touches on everything that you spoke about is that of trust, and that trust is very important for any institution or country or whatever, and when trust is broken, then everything falls apart. So, for example, with the Ponzi schemes, I feel like, of course, initially the people who make a Ponzi scheme, they have got the intention of breaking trust when a lot of people have put trust in that Ponzi scheme, and then they have invested a lot of money, and then the people who started it actually know that at a certain point when they have got their cash and they've got everything that they wanted, they're not going to meet their obligations. And so trust is broken, and then everybody does what is like a bank run, like they want to cash out. And this does not just happen on like private platforms, for example. It happens on a global scale, like the global crisis in 2008, for example. Everybody's now doing a bank run because some people were greedy and they made bogus, financial instruments that are not backed by people paying out their bonds or whatever. And then people are just going for a bank run because there's no more trust in a currency. And I think it's the same thing as well with Edison, where like, people no longer trust the mobile money. So you are paying a premium because they no longer trust it, right? So I feel like trust is a very important topic. So my question is there a way of making a system or something that you can literally trust it and know that trust is not going to be broken, and that whoever, maybe it's a centralized system, for example, maybe that has worked for quite a long time. We are trusting central banks and all of that, but they have also failed us. So is there a system where we can say, okay, we are really trusting this system, it's not going to break down, everything is going to work fluently, or we just say that, it's human nature to break trust, and so whenever that happens, we deal with it?
Thank you so much for your presentations. I had no idea that that was happening in Zimbabwe, so that was very enlightening. My problem is this significance that a lot of academics like to put on numbers. specifically this 628% increase in mobile money. Is it just an increase, meaning that when the situation was dire, a lot of people were looking for options, so they all signed up? Or is it about the continuous use? Because I would question and I would argue that maybe the percentage was the increase, that people did sign up, but then after that they never used the mobile money after, because obviously it doesn't seem like a valuable option.
Okay. So should we now go back? I'm sorry that that was so long, but it was so interesting to hear. So perhaps we want to go back to, oh, John? Sorry.
Several questions. Your one. Okay. I mean, your question, Eric, was, do the people always know best? And the answer is obviously no, unfortunately. I wanted to ask you of your paper. I mean, you talked about the people getting involved with prosperity gospels and so on and so forth, all of which makes it sound as if they're a bit stupid. But I want to ask you the question, let me start with a dramatic question. How do you make money in the world today? How, if you're one of the 1%, the Davos crowd of whom I spoke of yesterday, how do you make money? Arbitrage. You're not manufacturing anything. You are playing one currency against another. Do we suppose, that was my question to you, and that's where you make the big money. It is not manufacturing. Manufacturing, the Chinese can do it. We don't care. Is it not possible, in addition to all this, is part of the complex set of reasons these people get involved in all these things that you're talking about, is part of the reason not also that they're looking at what's going on in the world at large and saying, but this is the way to make money? How do you do it if you don't have, I mean, the whole point about it is not that they're stupid, it's that they, and this is, we come back to the point we've been discussing for a while. How could they possibly know? I mean, the secret of betting is always to bet a great deal of money to make a little. And do it repeatedly. If you try to bet a little money to make a lot, you lose it. And that's the unfortunate, because they don't have a lot of money, that's the unfortunate situation they may be in. They're trying to bet a little money to make a lot. Whereas, of course, the secret that the 1% is not going to tell you is that you do what Soros did, bet millions, millions and millions and millions on a small change in the exchange rate, and you'll make a fortune overnight. Isn't that what they're, isn't this another way of talking about that? So, I mean, how could they know what is best? It's a very complicated subject. The other point I would like to comment on, because we keep coming back to this point about the anthropologists and now also the historians romanticizing what it is that the strategies that poor people. I just want to I don't know whether this is still rife in American anthropology, but I remember 35, and that's telling you how old I am, 35 years ago, working in Kwatwa, we definitely said in a publication, there is a point beyond which all these strategies of self-help and looking after each other and mutuality and whatever break down. It doesn't always work. We need to bear in mind a lot of the people we are talking about now at the bottom of the pyramid are like the people in Kwatwa 35 years ago. People in Kwatwa 35 years ago are now worse off than they were at that point. So we do, I mean, I don't know why we all think we're romanticizing them. All I have ever said is that I think if you listen to the people carefully, that mobile money as a form of P2P transfer, that, as far as I'm concerned, is the only use case you guys have proved in 20 years. So I would say, no, we need to get beyond this idea. I'm not sure handing all of this over, as I've said to Milford before, I'm not sure handing all of this over to the state, and that's the challenge. We always say, oh, take it, this is bad, this mobile money is bad, because it's all run by private corporations or private companies. Well, you would hand over the financial system, which is obviously, you know, your bank, Reserve Bank, is a private entity, at least on paper. I mean, it's, you know, it's very close relationship with the state, but it has a certain degree of, and the EFF, for example, says, come on, we want to nationalize the Reserve Bank. Now, do you think that handing that over to the state under our present conditions, I'm not saying that's not the solution, I'm just saying it's a challenge. They could be as problematic as private corporations, which are obviously there to make money out of this game. So that's something I think we really need to give some thought to. How do we deal with this? It's going backwards and forwards between these two. We've got to get beyond these two options, which are the 20th century options. We nearly fought a nuclear war around should the state be in charge or the market. And if we repeat it, as Keith Hart used to say, if we repeat this debate in the 21st century, there will not be a 22nd. And we're getting pretty close with Putin. Okay. I don't know whether there's something else that somebody else asked.
Wasn't Eric raising his hand now? Yes. Yeah. Or
No. I was just actually reading his answer.
Okay. Okay.
There was something else which I had.
Yeah. Okay. Let's move the microphone up to Milford.
So maybe just jump in with something a bit different, but I just wanted to, like when we heard about how in how many different ways people in a village in Zimbabwe approach each other with different kinds of relations and names and such like things. It reminded me of something that also that I came across again and again, that is how people actually see the fintech landscape or the development aid landscape as something that is interconnected and like people who are actually receiving aid or who are like the targets, and how this interconnection is always rejected by the people who are actually going there to do these interventions. Yet when you look at how they move from one company to the other, understanding this as an interconnected ecosphere is actually very correct. But it allows people to shift responsibilities all the time, because they can always say, okay, I have nothing to do with that company, yet they are all well related. I don't know why I wanted to mention that, but I think it was related to the Ponzi scheme, like why these Ponzi schemes can also tap into this, because it is extremely difficult to understand this ecosphere because it's so extremely complex. Like all these kinds of different development aid agencies, all these small companies trying to come up with new apps. So for the user, it's very hard to understand who is genuine and who is not genuine. And people should take more responsibility also to show their interconnections instead of using that to shift responsibility.
Thanks. No, I think John, with respect, just slightly mischaracterizes my approach on this. I'm aware of the old dichotomy between state and market has really gone, because the Eastern Bloc has gone down, and so that no longer functions, and we have major problems in the so-called Western economies. So I don't really subscribe to that idea that it's one or the other. Or if it's not market, it's going to be the central state. Having said that, I mean, there are all sorts of exciting developments now in what people are calling the entrepreneurial state. I mean, you might be familiar with the work of people like Mariana Mazzucato, Bill Lazanick, where they're talking about the enabling state, that the state is reconfigured. It's not the old central top-down planned economy, it's a form of state that interacts with the market. That's something completely different. Completely different. And so that's one possibility in the sense that you might want, if you have what's called a mission-oriented state that is out there to design and operate and run things that can work in the market better for the majority, I think that's an option that's certainly worth trying. The other thing I would say is that even if you just ignore the central state, you've got all sorts of other options for the sorts of fintech that we're talking about. I mean, I'm going to talk a little bit about it tomorrow, not much. But there are alternative ways of doing it. I mean, you have local government type fintech programs that, using community currencies, okay? You have community development banks. You have cooperative banks which are in the private sector, but they have a social mission. They can be doing, adopting this exciting new technology to do all sorts of exciting things, protected by regulations so that they're not pushed out, excuse me, out of the market on an unfair basis. I mean, that's one of the issues that I think is coming up more and more, that if you say, well, wow, this is a real, I mean, I know this because I do have some connections to the International Cooperative Association, and they are looking at these platform cooperatives. They are having lots of problems because the technology is fantastic, but they simply can't compete with these massive fintechs, or banks turn fintechs, or vice versa. And that's a huge problem because they have a social mission, but they're small. Somebody, I forget which one it was today, was talking about scale. Scale is an issue. If you don't reach a certain scale, you can't possibly compete against the Safaricoms or the new banks in Brazil or whatever. So that's another issue that needs to be done. But I think there are all sorts of different ownership and control forms that fintech can be embedded within without relying on the old state versus market dichotomy. I mean, I think that is, for me, and we're looking at one type in Brazil. I'm not really going to talk about it tomorrow, but I'll refer to a paper we've done. But certainly, they are experimenting with different types of fintech run by community development banks, well, public banks actually, owned by the government. And it's an experiment that's sort of taking off, and it's showing really positive signs and going back to the point about listening to what people want, that's how the initiative came up in the first place. It was by listening to people that they wanted a way to change money with each other and to pay for things without using cash. And was it a good way to do it rather than going through the big 5 banks, or this new thing called New Bank? And this is really, they said, well, there is actually, yes, we can adopt and adapt the technology and do it. So I think there are lots of ways of doing it, listening to people in the community as to what they want. On the one hand, I do agree with that, but on the other hand, that you don't want to make a mistake. People don't know everything where they are. They often don't have the view from the macro view, and they don't have the intimate knowledge to know that something's a Ponzi scheme, because that's something a bit away. So it's a combination. It's triangulating the various things.
Yes, Tinashe?
Like if we should respond, because there are like so many questions. And yeah. Are you turning me up, or should I use the microphone? Okay. Where to start, Ivan? Well, the truth is we can't answer, or I can't answer all of these questions, but I will answer those that I think I can. And I think your question, Ivan, had to do with collaboration between, how do fintechs collaborate with the societies, and you notice the contradiction, and I think other people raised that question, between my presentation and Simba's presentation. I don't think there's a contradiction. I just think what we simply need to do is to simply nuance the presentations, because like John said, human beings, unlike what economists tell us, are irrational, right? They are not rational human beings. and whatever solutions they come up with at a community level are not always perfect. I was speaking to Sybil during lunch, and both Sybil and Eddie and I agreed that even in these community schemes that they come up with, some of them may be characterized by violence in instances where people don't pay up, or other forms of distasteful strategies to get people to pay. So what we're saying here is not that this is the be it and end all, this is the answer to these problems. We're simply saying this is an option. And the argument that we are trying to make, or at least the argument that I'm trying to make, is that there are multiple ways to approach solving certain problems. But if we take the kind of discourses and approaches that fintechs are taking, we're simply replicating imperialism discourses, top-down approaches to say, we know it, we know what solutions you need, so we will give you the solution to that problem, and sometimes they don't work. So what we're saying is also consider what these societies have to contribute, and somewhere there you might come up with solutions that work. That's number one. Number two, my presentation was also arguing that we must not forget that there are always multiple forms of money, multiple social schemes of welfare or rotating schemes or whatever it is. We must accept that reality. Except that if we're going to look at one of those multiple forms, which is fintech, one of the challenges that they're facing and failing to reach that bottom group is particularly because of the approach that they use. So let's nuance that and agree that when we're looking at fintech and its approach to these people, these communities, the fintechs are not going to provide the solution. There might even be just a passing phase. There might be a more sustainable solution that we don't know. But our approach to that is we must also involve those communities and have a sort of multi-focal approach to the issue. That's the first thing. Now, when it comes to these Ponzi schemes, 1.8 million, that's a specific group. And they're operating within a global financial hierarchy that's designed in a certain way. You are certainly likely to find desperate people who are going to try certain get-rich-quick approaches. If he tried it, I certainly didn't. I saw it from a distance. And so many of my other relatives might have seen it from a distance. But another relative of mine might have tried to convince me that this actually works. So let's nuance it. Societies are not, we shouldn't, what's the term? They are different. There are many people with many different interests, many different approaches, you know. So that's the first thing. The second thing has to do with the dynamism of money itself. Just like I said in the presentation, mobile money is one form. I think Eddie demonstrated that in the case of Zimbabwe, that there are many other forms depending on context. But even then, if we historicize it, what you're going to realize is that over the past 200 or so 100 years, you've had silver standards which have come and gone. You've had a gold standard that has come and gone. You've had a Bretton Woods standard, a reformed gold standard that has come and gone. We've got now these floating currencies that are being challenged with the tensions that are arising between Russia and Ukraine, and they are, you know, unraveling all of these tensions in the international monetary system. So there's nothing surprising about money being extremely dynamic, both at a macro global scale and at a local scale as well. So certainly, if EcoCash is not working at a certain point, people are used to these different money forms. And if we take specific case studies, my case study being Zimbabwe, you will realize that certain money forms can be very useful for maybe 7, 8, 10 years, maybe 20, who knows? And then it becomes not so useful. So it's a question of how people navigate, you know, power and try to empower themselves by utilizing all of these different tools and strategies to see how they can, you know, get something back from these extractive systems. Another point I suppose I should make is that let's not look at Africa in a vacuum. Let's look at Africa in a global context. If I go to Europe today, one thing that I notice is, well, it's got its own challenges, definitely. If anything, has demonstrated that Brexit in Britain is clearly demonstrating that it's also got its own challenges. But compared to Africa, their welfare systems have been sustained by certain historical forces that have made their situation certainly better than that in Africa. So the question we are asking is, in the context of Africa, with its specific type of history, how do we model certain systems that work for them, right? And somebody said to me, look, I think it was Ivan, as we're going out, we've got fintechs coming in and telling Africans how to resolve their problems. You don't have fintechs getting any suggestions from Africa and taking them to the global north and saying, here's how you resolve your problems and your challenges with payment systems or whatever. So it's a question of saying, let's not just imperialize this and let's look at it from a different perspective. So for me, there's no contradiction between your paper and mine. And then there's a question of a juxtaposition. I think it was Kevin who asked that question. Is regulation part of the problem when designing fintech products, and are some of these ideas scalable? The honest answer is I don't know. But it's something that I may want to look into. But in terms of its scalability, I'll connect your question to the point that Hannah made about ZCC, the example that she just gave. I also heard about that. What Patrice Motsepe is doing is that he is taking a sort of community and trying to, utilize that particular community that is connected by religion, that is under that Zion Christian Church. And he is trying to work out a deal with this bank that you spoke about to see how best they can help that particular community. Now, 12 million people is not a small number. That's a significant number, which means this is actually quite scalable. But how is he doing it? They are not advertising their products on television. They are not approaching these people from a position of saying, we have this product, come to us, we will help you. They've got a team that's going to these people and saying, what is it that you guys need? You're a church, you've got you do things a certain way, you're a community that operates in a certain way. How can we partner each other in a way that helps you and that allows this particular corporate to actually make money without necessarily just exploiting these people as well? So scalable, I think so. My example was simply to point to answer your question. When you say there have been so many studies about this, yes, there have been. And not just in the last few years. There have been so many studies from the 1950s onwards. Anthropologists have looked at this, historians have looked at this. But why is it important for me to present it now? It's in a very specific context. We're talking about how fintechs can help communities, right? And I'm not so sure I've read any study that is trying to connect these fintech solutions to some of these challenges that we face. So I've taken a specific example that perhaps no other scholar has done, because I know the community, and it's very tiny. And I'm saying, how can we take that particular community, right, and find fintech solutions that respond to their issues in a very cost-effective manner, right, but which also allows the fintech companies to also benefit in terms of profit in ways that are cost-effective to both. And what I'm suggesting is, this is one community of 250 people. We've got, the example I use, 4 million Zimbabweans. We've just had the example of 12 million ZCC members. What products are likely to come out of this, and how can they be innovatively developed in such a way that they help the people and help the companies that are investing to make a profit out of them? Because it's not always that having people pay 299 Rand a month will make you have a profit. You can actually have a community that pays you 37,500 Rand in one go, and you have 100,000 of those, and you actually make a lot of money, but these people are paying far less than they would have if they were doing it individually. So what does that mean? What kind of apps or whatever can be developed to, take advantage of that situation? I don't know if there are any other points that I can look at. Yes, I think I agree with John about the question of arbitrage, but where I sort of disagree, not entirely, but partially, is the question of romanticizing poor people. I suppose, in a way, I try to answer that, because you're absolutely right. It's like in history, we have this concept of the merry pre-colonial Africa approach. No, colonialism is very bad, but pre-colonial everything was good. No, that's not what we're saying. But sometimes, when you're confronted with discourses like the ones that I try to present on, of a currency revolution and so forth, the natural thing is to say, no, hold on, but you're forgetting these good things. And in fact, perhaps what you're suggesting as a revolution and as a good thing was not necessarily that good. But the point actually is that there are many challenges to all of these things, except that we need to kind of consider all of those approaches. But I do take that point. And I will argue that in those attempts to try and find their place in these societies, you will always have challenges. You will have violence. You will have people even killing each other, the example that Eddie gave to me earlier on. But what we must recognize is their attempts to try and reclaim something back, reclaim a space and say and express themselves in certain ways. So that we must not dismiss, just as romanticization. And I think maybe that's the last comment that I have. Maybe, the last one by Ivan, about how people see the development landscape. When you're talking about how they reject certain platforms, accept others, and use them interchangeably as they see fit, if I got you correctly. First of all, I would say that what we're discussing here is very specific. But when it comes to the idea of development, for me, I think it's a highly problematic concept. And unfortunately, when it is imposed from above, it has very specific ideas about what it is, and it is not always understood in the same way within these communities. When politicians talk about development, they're looking at GDP figures. They're looking at how much foreign exchange they've got in the central banks, right? They're looking at how their country is performing in terms of any development indices against others. But they're not looking at necessarily such things as inequality within their nations. I think economists call it the Gini coefficient or whatever. You take the example of South Africa and the example of Zimbabwe. I like using those two examples for one reason. Zimbabweans tend to appear to be coming from a place where they're struggling a lot, and South Africans tend to be better off. At least this is what's in general, what people think. But when you nuance it and when you really get into it, what you'll discover is a lot of the Zimbabweans that come to South Africa are taking advantage of certain openings and opportunities that may be there. That doesn't necessarily mean that because their economy is characterized by hyperinflation, political crisis, and all of those things, they are necessarily suffering. If you go into those communities, you begin to understand their understanding of how they're operating outside of what we know as an economy, and they've carved for themselves other livelihood strategies that make them survive better. You will never see, or you rarely see, a place where you've got like sort of a squatter camp, these settlements where you've got plastics and so forth, in certain places in Zimbabwe, particularly because these people are building houses, big houses for that matter, in certain places. You go to the rural areas, they have ways in which they survive. But that's because while there's inequality, it's not as bad as you would find in South Africa. South Africa has the highest inequality in the world, although by all accounts, it has the highest GDP, if not after Nigeria, it probably has the highest GDP in sub-Saharan Africa. What does that tell us? So all of these things, I'm just saying that when you need to be very critical of it, but when we're now looking at these community schemes, last sentence I hope, they are navigating this landscape where all of these things are thrown at them, whether they're calling it development or whatever, and they're trying to just carve a place for themselves. And what I'm saying is, let's listen to them and let's see how we can try to speak to them and try to provide those kind of services. Thank you.
Thank you. There was one unanswered question. I wonder if we could go back, if it's okay, since I was taking notes. But Simba, Cherney asked who owes the investors, I believe. Was it Yeah, so could you talk about that a little bit? In other words, who was kind of left holding the bag? It wasn't just there was a Ponzi scheme on many sides, so maybe you could,
Yeah, I think it's interesting maybe to look at...
Question? I'm taking bad notes, I apologize.
Yeah.
Yeah, it could have been Hannah's question. I'm sorry, I tried to take...
Was,
Cassius?
Yes,
oh,
yes,
sorry.
Yes.
Okay.
I think your question was around technology and virality, right? Yeah, I think maybe it speaks to what I was talking about in terms of the kind of ideology that was being propagated when people were being converted into this, because, I mean, they imagined themselves as a community. But I think what is interesting is that this was a community of strangers. I could send money to people that I don't know. The system gives me a number, but the assumption is that they're part of the community that I'm also part of. And there's an element of trust that was constructed. So money was given in this context in the spirit of giving, the idea of gifting. You are gifting someone who is in the community with the expectation that at the later stage, when you need to then use this money, you get it back from another person. Not necessarily the person that you have given who is going to give you back, but it's another person whom you don't know and who doesn't know you. So that is quite interesting. So I think in terms of who owes the investors, I would say it's the community, this cyber community. And I think that is also interesting, even in the ways in which people attached meanings to the collapse of the investment scheme. What was interesting, I think, is something that I probably should have foregrounded in my conclusion, that if you look at the gentleman that I called Andrew, who lost the money while planning for his wedding, coming from a very Pentecostal, with a Pentecostal habitus or a Pentecostal subjectivity, it was not entirely a loss or a material loss of losing money, but the interpretation was this was a spiritual attack. This was a demonic attack, not only on his wedding, but also on the wealth. So it's something that was very interesting. Of course, this is not entirely the story, because there were other people that were also not coming from a religious or spiritual background, who also have their own interpretation of what the collapse meant. So you would have a situation whereby the church pastors would say, let's pray for this scheme. Why? Because you've requested your help. When you log into the system, you still see that the money that you requested is there. It's not erased. Let's pray for this. Let's have faith. Let's have hope. And in some cases, there were some money that was also being repaid after it was initially frozen. I think that was also the case in China. That was also the case in Nigeria, where it was frozen and then resuscitated and then eventually collapsed. So I would say it was the community which owed these people. And because they gave this money in the spirit of giving, you know, the gift economy, you could not go to anyone. But it was interesting also to look at the nature of relations and the configurations and reconfiguration of relations. For instance, if I had introduced him to this scheme, and then he uses his pension or get a loan from a bank, invested and then collapsed, and he still continued to see me. What does that do to the trust, to the relations that we have? Of course, there are many different outcomes: violence, conviviality, loss of trust, and many other things. That's why I was saying what was really fascinating for me was what else is lost or gained. I mean, apart from the material money, in terms of relations, in terms of sociality. I think that could be one way of looking at it. And indeed, like what you were saying, technology was an important part of this kind of scheme. Why I did not foreground it was because probably it would go back to the idea of metrics and algorithms. But I was really interested in the social and the socialities. But it was very an important part of this kind of technology. Actually, the church leaders during church services and business seminars, investment seminars that they organized, where they propagated all these kind of investment schemes, they actually use the same kind of logics that they used when someone is healed of cancer and there is a testimonial that is posted on YouTube. The same kind of tactics were actually being used where, especially the early entrants into this Ponzi scheme, who amassed millions of United States dollars, bought houses in fancy suburbs, expensive cars, they would flaunt them to say, you know what, since I joined this community, I've bought a house, I've bought a car, things that I could not have done because of the nature of the economy. And this is posted on YouTube. This is shared in the church business seminar. And it attracted quite a lot of other people. So technology was actually very central in the logics of how this scheme operated. Yeah.
Thank you. Yeah, other.
I would like, I mean, all of us, and I'm sorry, I think there's a lot of common ground between us, Milford, a lot. And I think it comes, I mean, one of the topics we should focus on, and I don't hear the academics or the fintech people talking about it, is that the problematic aspect of all these currencies, mobile, cryptos, and so on, is they're all conceived of as being similar to fiat money. They're all purpose. And it implies, when you say, when one says, we want to replace cash or fiat, then obviously the replacement has got to take on all those features unless you're very careful about it. And that's the problem. The real problem here is the all-purpose. Maybe the Zimbabweans are actually not behind. I mean, it doesn't work well at the moment, I grant you that. It's obvious. But the notion that you can have different currencies for different purposes. So I can see a situation in which, in future, the ideal would be to have a suite of different currencies which we use for different purposes, like you can in Switzerland, and there it does work. You can pay with all sorts of currencies. And we have a range of levels of government. We know the state is too small to do the big things and too big to do the small things. So we need to have a range. I mean, climate change is not going to be solved by national governments. In fact, one could go further and say that the state, the nation state, which is as old as fiat currencies, it's not hugely ancient, has now become a reactionary force in the world economy. It's a barrier to getting things right. Which doesn't mean to say one wants to do away with nation states, but they cannot be the only level of state, or the only, whatever we call it, only level of governance. It has to be local and provincial and whatever, and global. Otherwise, we're going to kill ourselves pretty soon with climate change, as we know now for this week. So those two go together. The levels of state, levels of money, different forms of money. But I keep coming back as I listen to everybody, all of us. We still have this, because we're so used to it. It's the only, and it is Adam Smith who told us this. Money makes barter easier. Well, then it takes on all these functions. And a huge part of the problem is as soon as you have it as a whole store of value, the rich will appropriate it. And the poor will not have enough. Now, that's what Tom Greco and all of them are trying to work on. It's not easy. You will tell us how difficult it is in Kenyan examples. But it's something I think one needs to persist with. The only question I have, I can see that money is important in this. Mobile money and cryptos, I'm not so sure. You've got to make the case to convince it. Money is a crucial topic. Because money is one of the great, it's like language. It's how we communicate. It's how we scale the world up, scale ourselves up and the world down. All sorts of things.
But whether it's these particular forms is another question.
Yeah. I don't think I'm here to make the case, or if I've been making the case, that mobile money or crypto is superior to fiat in any way. In fact, I spoke about the stickiness of cash and how the characteristics around being instant, the characteristics of being instant and interoperable, right? Whether that's fiat or any form of money, that's not easily replicable, I think, by any sort of what you'd call type of money. And I think those are really complex challenges to solve within payment systems. And there's no silver bullet to it. I just want to be fair in saying that, like, I've not been sitting here making the case for crypto or mobile money. I've been speaking more to I think the challenges around it. I mean, some of the concepts I was hearing earlier today at lunch were pretty interesting, especially this concept of giving, right? And there was an example from the UK about, sorry, the lady right there on the end, that was speaking about charity work and how that could be almost tokenized, and then, you know, what do you call it? Like if you were young doing charity work, you could tokenize that in some sort of system, and then when you get, you could get some sort of charity work done for you, or some care around that. But that's still it's still a voucher system. It's still a store of value, is it not?
I think, yeah, so I did see Simba's hand first, and then Shaila, yeah.
I just realized that I think Prof. Shabet asked a question which I think is important to also talk about in terms of the people that invest in this Ponzi scheme within Pentecostal. It's not, I think I do have, I think you were saying, are these people stupid to invest in this kind of Ponzi scheme, maybe because of their religious subjectivity? But I think if I look at what these people say in terms of their worldviews, I wouldn't say that, and I would also represent them as such. For them, actually, this was an efficacious way of trying to get by. And I think that, of course, can also be related to, you know, the classical anthropological work around the cargo cows. Within these Pentecostal churches, you actually see that the idea of making money from nothing is quite embedded. In some of the services that I attended, for instance, I think my Zimbabwean and other African colleagues would agree that within Pentecostal and prosperity gospel, there is a huge belief in what they call miracle money, where declarations are made and then people just find money in their mobile e-wallets from nowhere. And whether it's true or not, I think it's another issue, but it's something that they believe in. That, you know, if God can turn one fish and 5 loaves of bread to feed thousands, this is also possible. So it's not something that we should probably take as stupidity or irrationality. I would probably think of it as, you know, a rational ways of getting by and making do, especially for these particular people. Why? Because they see it happening even in secular spaces, where people make these investments and then all of a sudden become rich. And this is what even the pastors and other members also ride on, that kind of examples. Yeah.
Hello? Okay. Just to respond to you, Prof, the idea of multiple forms of currency, having one currency for one item and another currency for another item, this was the premise for DLT, Web3, cryptocurrency. This was what people were trying to do. And that's why now you can use your Ethereum to buy your art, and you can buy, let's say, I'm going to shamelessly plug regen here, but your regen tokens to pay for regenerative practices. This is the reason that it all started. And now it's been marred by like all these shit coins, that's what they're called, that come in that are saying, okay, this is Dogecoin and you can use it to buy some accessory or something. But the premise and the reason that these coins were created was for just that, that you can have this for energy and you can have this for this item and for that item. So I'm not, like Shanae said, I'm not glorifying blockchain or Web3, but I think that this was why the technology was created. And you can see that if it was used in the right way, if the governments came on board and actually regulated it and created policies and worked together, then we could have an energy token and an electricity token and maybe a social protection token for those in need.
Behind. I don't know what people feel because we're only 10 minutes behind, but we can go 5 more minutes. I think Jonathan first, and then Kevin. Yeah. Yeah.
Just a 1-minute comment on the traditionally tight relationship between one state and one currency is up for renegotiation now. You know, and the case of Zimbabwe is a case where it's being renegotiated, right? There's not one currency, or and you know, we saw that in the practices. And that challenges already our idea that one state has one currency, or that currency is a reflection of state power, or is certainly closely tied up with state power. There are other places like that around, you know, Venezuela and Cuba and places where the currencies essentially don't reflect the power of the state anymore. And then what's interesting is now with digital and crypto, and I'm not putting a stamp of approval or disapproval on it right now, I'm just pointing at it, there are imaginations that this is the moment when, you know, crypto is going to step into a new role, essentially, that would decouple a currency from state power. And so far, it's off to quite a rocky start. I mean, ask El Salvador how it's been doing with Bitcoin and adopting Bitcoin. You know, there's a long way to go to figure that out. Again, the research community here and the innovation community working in fintech and beyond can look to these places that disrupt that one state, one currency dichotomy, which we've assumed is the only way it could work, and probably learn some lessons from that, so that hopefully the next time a country jumps for that decoupling, it doesn't end up like El Salvador.
Is the supremacy of the US dollar. That's one thing that we haven't, yeah. But Kevin. Yeah.
I'm thinking out just based off the different components. So Prof. Tinashe said, you know, something quite profound, which is, you know, human beings are irrational, and we economists want to make us think that we're rational. And so I want to speak as an investor just to sort of speak to Professor Sharp's comments, which is, as an investor, my objective is to capture value from value created or perceived value created. And it's very important to me as an investor that whatever currency I use is both a means of exchange and a store of value, because that efficiency is what makes me remain or stay with the value that I perceive that I've captured. So I'm just thinking aloud. That's my comment.
Oh, can I? Oh, okay. 2 things. Taking from what both of you have just said about the, yes. I haven't even finished a sentence. In all of the discussions, we're forgetting the question of power and the supremacy of the US dollar and how it informs all of these discussions. That's the first. The second and last has to do with Simba's comment. I think there are Zimbabweans who think those people who get involved in cryptocurrencies are actually very stupid. And I think we shouldn't see Zimbabweans as one thing. That's just a quick comment. If you get caught up in cryptos. I was stupid once because my stepmother wanted to go to Nigeria to visit this prophet who eventually had a church collapse. I'm forgetting what his name is, because she wanted to have her legs healed. And we all went and paid, yes, we all went and paid money to this organization which was connected to him, I think almost $1,800, and she never got to take the flight, and she never got to go. I had thought this might be too good to be true because they were offering hotels and tours and everything, but I still did it. And I looked at myself and I said, how stupid can you get? So I understand where you're coming from, but I think let's consider that people have different views and perceptions about these things, and actually other people in Zimbabwe do think what someone like me did is stupid. Thank you.
Yeah, but the people themselves don't consider it as stupid. Some are even still hopeful up to now
Yeah.
within these kind of changes.
True.
Yeah, but of course not everyone.
Yeah.
Yeah.
Okay, thank you so much, everyone. We are adjourned for the day. Thank you.